With that, some dollar weakness. The euro just about reclaiming 110 here, Lisa, 110.04.
And one theme for me this week is the disinflation that we're seeing in used car prices, as you mentioned, in some of the smaller businesses. Is it a head fake as year-over-year comps get more complicated throughout the rest of the year? Today, the NATO summit is in focus, especially as President Biden meets with Erdogan of Turkey, the president there, at 11 a.m. Eastern, the tit-for-tat of F-16s. We get some more sense of that, as well as signs of what kind of unity there is around Ukraine. Also, starting today, going through the week, we have the Sun Valley Conference on the future of new media and all things streaming, very much in focus. This year will be Meta. Those shares are up 144% so far this year. And Threads. Last year we talked a lot about Twitter and Elon Musk. Elon Musk will not be there this year, perhaps symbolic, at a time when everyone's focused on Threads, which seems to be gaining traction.
I don't agree. Level. I think I'm going to delete it. To me, it's a nuisance. I don't.
Are you done with Threads? Breaking news. Let's go. Why are you done with Threads?
It's just the linkage to Instagram. I don't want to see people getting drunk on the weekend, and that's basically what I'm watching on Instagram.
I thought that you liked bar chat.
Well, I like bar chat.
He likes getting drunk on the weekend. He just doesn't want to see other people doing it.
Exactly.
Bar chat gives me bar charts, but I'm sorry, with all this uproar, I'm like, why do I need this?
Well, you might be in the minority if we just take a look at the signups, although really involvement and active usership will be the key. Moving on, we're also looking at Amazon Prime Day, which everyone forgot about. It starts today and tomorrow. It is interesting, not only if you want to buy an iRobot, which I think would be interesting, but also just the idea that they're actually gaining less traction in all of these Prime days. They're increasing their sales less year over year with every consecutive year since that 30% increase in 2020.
Do you think you save money?
No, but it's highly convenient. I don't know if you save money on Prime Day. Prime Day, you probably will. I'll give you an example.
Lisa,
Saturday night, I rewatched Gladiator. Just one of my favorite movies of all time. Rewatched Gladiator, and then thought, you know what? I want to get Meditations, which is Marcus Aurelius's book. So I ordered it Saturday night. It arrived Sunday morning from Amazon. I mean, come on. Who else provides that kind of service? It's nuts.
100%.
It's so convenient.
I ordered a standalone tent of mesh
for
my younger son, and it came overnight just in time for his summer program. It was fantastic.
It's great. It was
with all the
Phil Camprelli with us around the table. Doesn't want to talk about this. Multi-asset portfolio manager at JP Morgan Asset Management. Phil, you understand. Amazon, right? Come on.
And I love Gladiator as well.
Great movie.
Great movie.
Thank you. Thank you.
We're recreating it.
Let's talk about this market. On Friday, we get some earnings. We won't talk about your bank specifically, of course, for obvious reasons. What are you expecting this earnings season from the banks, from big tech, and can this rally broaden out?
John, so it's going to look better than it did in March. I think there were so many head fakes and noise at the end of the first quarter that even the Fed got faked out on, right? They expected us to be in recession by now. There were a lot of people saying that by July and September, the Fed could be easing. And as you said, right, this is a year where the narrative changes every single week, and that's true. John, we have dropped our recession probability from 40% in March to 25% now. We are pretty highly convicted that we're in the midst of a soft landing. So what does a soft landing look like? It means that the economy can continue to grow and avoid recession, and that's why we dropped our probability. The second piece is employment stays strong. And I think that's been the signal all along. Like, there have been people like, we're going to recession, we're going to recession. You need this labor market to crack. And that has been very, very resilient over time. And then the third piece is the easing has to get pushed out. And that, I think, was one of the biggest misses this year, was that there was so much easing priced into the back half of the year that had to go along with the crisis. You had to be long a crisis if you believed in an easing in the back half of this year. Now, the deflation trajectory flattens out. That's certainly the case, which is why the easy is being priced out. You heard Mary Daly last night, 2 more hikes. I think that's appropriate. They're probably going to do 1 more hike than they're comfortable with, because we're nowhere near our target of 2% core inflation. But it is an awesome time to be a multi-asset investor. We're up 10% in the first 6 months of this year in a balanced fund. Nobody's talking about that. Everybody's talking about NVIDIA. I think the balance fund up 10% is really exciting as well, and certainly more than that 3-month T-bill that's at 5%. That's been my nemesis all year, and there's way too many people.
I love your research note, the concision of it at the end. You say, do this, do this, do this. But the Phil Camparelli idea here is you got to be in the market.
Yes.
I want you to talk right now to people who are scared stiff. What's the level of fear out in the street? Because don't you have to go up with a wall of worry?
Yeah, so, and we've heard it all year. We've heard debt ceiling. We've heard regional bank crisis. It was a foregone conclusion that there was going to be a recession this year, Tom. And I'm not talking people to get out of cash and go into equities. That's not what I'm saying. I'm saying when you're making a bet on a balanced, diversified portfolio, which, by the way, has worked over so many years, you're not making a bet on stocks or bonds. You're making a bet on the relationship between those two asset classes, which was absolutely inverted last year. Last year was the first year since 1974 that both stocks and bonds went down in the same year. And I came on this show and told you, you know what, we have the best forecasted return for the 60-40 that we've had since 2010 coming into this year. So, Tom, those are the folks that I'm after. They're sitting there in the 3-month T-bill. It's like the best hedge fund out there, right, at 5+%. And they're saying, I'm safe here. Well, you know what, if the balance fund's up 10% in 6 months, their opportunity cost just went up.
That said, you talked about the soft landing probability, which hinges a bit on disinflation.
Yes.
Ongoing.
Yes.
We've seen disinflation with used car prices going down, as John mentioned. We've seen disinflation in some of the rental prices. We've seen disinflation even from the smallest small business survey. If you look out, that starts to change later in the year. Is the disinflation that we're seeing a head fake, and could that be a real potential risk?
Lisa, that's our biggest risk to our forecast. If disinflation starts to trend higher towards the end of the year. So, when this base effect of June rolls off and we get this move on tomorrow's CPI number, the risk is, and I think this is why the base case has to be for central bankers to talk extremely hawkishly. They cannot afford to let the 10-year Treasury move lower in rate. Why? Because that controls the housing market. And if the housing market and the owner's equivalent rent part of this shows firmness towards the end of this year, that's a scenario where you could have equities going down and bonds going down. Not to the same extent of last year. Last year was a historical event, but that's probably our biggest risk, that disinflationary curve starts to trend higher, and instead of sticky inflation, accelerating inflation happens, and that would be our biggest risk. Now, that's not our base case. We're not investing for that, but that is probably more of a risk than the U.S. falling into recession by the end of the year.
What are you invested for? 3% inflation, a return to 2? Do you see anything compatible with a return to 2 right now?
No. So we don't have enough of a growth kind of deterioration story, John, that would speed up a disinflationary back to 2% before the end of next year. Now, that doesn't mean that you can't invest in this market. As long as the disinflationary process continues to occur. If it's flat, it's okay. Maybe you don't get the return in bonds, but maybe you start to get that breadth story in what I call the S&P 490, which is everyone else, to be able to keep the market going.
It's like the Dow 27. I'm looking here, John. Headline inflation, 4% prior, plunging to 3.1% survey. I don't think enough has been made about tomorrow. You get a headline inflation number. What if that comes in at 2.9%?
Two handle. That mixed it up.
Stunning.
But they know that. They know that last June's number was 1.2%, and that's rolling off. So if you get a high 0.1 or a low 0.2, that's a base effect. That's not going to make them say, let's wave a victory flag on inflation. And I think that's the real signal.
I'm trying to make this exciting, Bramo, going into tomorrow morning.
We're doing a great job.
We're working.
Thanks. Phil Camparelli there, JP Morgan Asset Management. You can tell he's an asset manager excited about the returns of a balanced fund of 10% when NVIDIA's delivered 188. If you are just joining the program, welcome to the program. Equity futures right now positive by 0.15%. Coming up at 7:30 Eastern Time, so about 20 minutes from now, Lara Rame of FS Investments. Lisa, on that inflation data just around the corner.
And I think what Phil was saying is really interesting about how the biggest potential risk is not the U.S. falls into recession, but it keeps chugging along. And then what happens if the disinflation that we're seeing in certain areas reverts and restores the idea of an inflationary kind of push that forces the Fed's hand? That seems maybe increasingly likely if you take a look at some of the data.
We've got 50 seconds. Let's do this. TK's off Threads. We've all said Elon Musk needs to get on it over at Twitter. Can I breathe some life into the conversation you're having out on Twitter at the moment? Bramo's got a fake account. Except
I've got so many
the
fake
fake account's been verified and has 8,000 followers. Yeah, you just have a look on it. It's got a nice blue tick next to it.
Oh my goodness,
They
seriously?
put an extra Z on the end of your name.
They blocked me.
Of course they do.
Yeah, so I can't see any of
that's
it.
the account with the blue tick on it.
This is the reason why Twitter is losing a lot of traction. I have
Totally.
tons and tons of impersonators that I keep reporting, and it
I
doesn't
don't have
seem
any
to work.
impersonators.
And they use that word, and I just
how
used
come
it.
she isn't
Verified.
Yeah, yeah.
It's not verification
No,
at all. It's just a blue
exactly.
tick because you're paying a monthly fee.
Someone asked me to wink twice if I was the real me, and I am winking lots, and thank you.
Is that
for
why you were doing this?
Yeah, that's why I'm
looking
just
over
violently
at her,
blinking.
It's like, what are you doing?
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He's
story.
there to kind of upside.
The top names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Earnings season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Adding of Finland and Sweden to NATO is consequential, and your leadership really matters. And we agree on the language that we've proposed, that you proposed, relative to the future of Ukraine being able to join NATO, and we're looking for a continued united NATO.
The President of the United States speaking at the NATO summit alongside the NATO Secretary General Jens Stoltenberg in the last hour. TK in a commercial break, very proud of himself. You've managed to deactivate Threads.
I figured out how to do it.
How do you do it?
I had to email Anne-Marie Horton in Lithuania.
And you've deactivated that without deactivating Instagram?
I think so. I don't understand it really.
All right.
I'm on Threads. I'm experimenting with it. I think it's
You let us know. You can be the Bloomberg surveillance account on Threads. There we go.
I could go back on. I could go back on.
You were going to do that for us.
You know.
No, I think I'm done, Tom. I don't need another
Anne-Marie
platform.
Horton's up to 145,000 followers.
That doesn't surprise me.
I mean,
AMH is big time on Instagram.
She's like,
just massive.
She's huge.
Huge.
I mean, let's do this now with futures up 6. John, what else do you see on the data screen? We're killing ourselves
Not
on
much.
data. It's not
Yields
much.
are coming in, dollars a bit weaker.
Yeah,
That's kind of the story of the last couple of days. Down 3 basis
That's your
points on a 10-year.
professional Bloomberg surveillance
Break it
data
for
check.
396.60.
Fortunately, we have a lot to talk about with Anne-Marie Horton, our Bloomberg Washington correspondent in Vilnius, Lithuania. Anne-Marie, just simply, what's been the biggest surprise as you landed in Lithuania? What's the single thing that sticks out right now?
I think right now what sticks out is the tension between Ukraine and the NATO alliance. What you have is Biden, as he's being welcomed by Jens Stoltenberg to the meeting here in Lithuania. He said that we agree with you in the wording you put forward in terms of, at some point, how they could see NATO, Ukraine becoming a member of NATO. And then what we saw on Twitter was really a scolding from President Zelensky, saying as he is on his way to the NATO summit, he can't believe they're even discussing the language regarding Ukraine. There's some reporting in the FT about how it potentially will be hedged in a statement about their ultimate, potentially at some point, an invitation and a membership to NATO. And it looks like Zelensky wants more than that. It looks like he wants specific timelines and dates. And I just don't see that happening at this summit in particular.
Well, I was going to say, Anne-Marie, just how unrealistic is that?
Well, the president has made it pretty clear, right? He was on CNN over the weekend. He said that he doesn't see that it's unanimous support just yet. And he said that there needs to be more that has to be done within Ukraine, not just the fact that right now there's a war in a country, but also the fact when it comes to democratization. He says there needs to be more that needs to be done in Ukraine before they could see this ascension into the NATO alliance. Now, there's a lot of countries that have mixed feelings on this, and there's also a open letter to the president from a number of foreign policy experts and former U.S. officials who want to see a quick path of Ukraine to join NATO. And some of them say that when it comes to Article 5, one way they could potentially get around that Article 5 is that they would claim that the territory that Ukraine has right now would be the only territory that Article 5 would have to respect and go defend. So basically taking away the likes of Crimea and other areas and territory of Ukraine that Russia has illegally annexed.
Anne-Marie, the former president turned up to NATO once and made a series of complaints. And a lot of those complaints resonated with many people, and many years later, they sound spot on. The contribution to military spending of some of these countries, some of these members of NATO, has it improved? As you look around the room right now, is it still just the United States doing the heavy lifting?
I remember that NATO meeting very well because I was there, and the former President Trump caused quite a fluster when he was really demanding and potentially wanted to even break up the meeting until he got some serious commitments. By and large, it still remains that the U.S. is doing the bulk load when it comes to the military spending of this alliance. But it is fair to say, looking at some of the numbers, you've seen an uptick of some of these countries in terms of their military spending. I think two key things you want to take away from this meeting is that they want 2% to be the floor. So that needs to be the minimum that all these countries need to be spending, and they're really going to emphasize this at this meeting. But also, a lot of these countries at this NATO summit are going to come out either on collectively or single-handedly talking about what they want to provide in terms of military ammunition and support to Ukraine. So there's just the defense spending, but then there's also what military equipment do they have now that they are going to earmark and say, well, this is going to go for our support to Ukraine.
A lot of people expected Volodymyr Zelensky and Ukraine to be the center of all discussions at the NATO summit this year. However, Turkey's Erdogan has sucked the oxygen out of the room, not only with some sort of tit-for-tat demands with respect to allowing Sweden into the NATO Union, but also just in general, its desire to be part of the European Union. What are we looking for today with the summit between President Biden and Turkey's Erdogan?
Well, I think what you're going to hear is Biden or Erdogan come out and say that the F-16 saga that has been going on for months, for years, is over, and they're likely going to get that delivery and shipment. I like how John called it a wink, wink, nod, nod. Everyone knows that this has been really the discussions behind the scenes, and there's been pressure of some key senators like Bob Menendez, of the chair of the Senate Foreign Relations Committee, to really make sure they can green light those F-16s. And then Erdogan, in turn, last night green-lighted Sweden's path. What I think you saw when he was trying to link the European Union ascension of Turkey into the EU was his way of trying to extract any sort of concessions he can get as he has this power, because he knew everyone around him really wanted to make sure that they can claim victory at this NATO, that it wasn't just Finland that's now in the group and they're celebrating Finland's ascension as well, part of this summit, but that they finally were able to get Sweden. And really, beside Kaliningrad, they now have an absolute hold on the Baltic Sea. So this was really important for the NATO alliance and for the president. And what you saw Erdogan there, coming off an election, is just really using the support he has at home and just trying to extract as many concessions as he could.
AMH, thank you. Looking forward to touching base with you again in about an hour from now. We'll do that with Maria Tadeo. Some fantastic notes on Wall Street in the last couple of days. I've enjoyed it, so thank you if you are listening. Thank you very much. This from Torsten Slot. We talk about Slot's research lots. This is what he has to say this morning. The flawed logic in the current market narrative. The market seems to be of the view that if inflation quickly returns to the Fed's 2% target, then everything will be fine. Stocks will continue to go up. Credit spreads will continue to narrow. There are some problems with this logic, he goes on to say. Here's one problem he identifies. If inflation comes down faster than the Fed expects, it is because the economy is slowing faster than the Fed expects. For example, if wholesale car prices decline more quickly than expected, then it is driven by a sharper than expected drop-off in demand, Tom, for cars.
I totally agree, and even more so, I'd overlay it across nominal GDP. If you get inflation to come down with some kind of real GDP tepidness, you get a nominal GDP, dare I say, I can't believe I'm saying this, 4%, under 4%, and that directly affects the revenue line of corporations, and that's where you get into the earning debates. That's where you get very Mike Wilson.
He goes on to say, the Fed and academics agree that it takes 12 to 18 months before monetary policy impacts the economy. And this is true both when the Fed is raising rates and when they are cutting rates. Lisa goes on to say, so if inflation quickly declines to 2%, we would still have 12 to 18 months of slowing growth ahead of us. This is a pretty bearish view on the way the market's positioned going into some of the economic data later this year.
It's exactly the opposite of what Phil Camporelli was saying, talking about some sort of soft landing that a lot of people are talking about. Here's the problem with this. We're still in pandemic economics, according to Tom Keene, the great economist across my way. And we still have a lot lot are not working the way that we otherwise thought. Read the housing market.
It's the nicest you two have ever been to each other.
Hey, I think that was one way, actually.
What happens after the sixth deer flies, she becomes a heaven.
Well, you've got to give Bramo a compliment now, Tom.
I do?
Yeah, you've got to pay it back, of course.
Okay. She's a toxic brew.
Oh, I'm so...
Lisa, you tried.
I tried.
You tried. Lara Rain, FS Investments, up next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
Stocks picking up a little bit here on the S&P 500, on the Nasdaq as well. On the S&P, positive by 0.2%, up by 0.25% on the Nasdaq. Look at us string together a couple of days of gains on the S&P 500. Continuing to read this note from Torsten Slok of Apollo. The lagged effects of the Fed hikes will continue to drag the economy down over the coming 12 to 18 months. That is why recession is more likely than a soft landing. I'm not saying Torsten has done this to counter New York Fed President John Williams. I'm just suggesting it does counter New York Fed President John Williams this morning, who said to the FT, I don't have a recession in my forecast. I have pretty slow growth. This is the debate going into the Federal Reserve meeting later on this month with a two-year yield briefly through 5%. We were looking at 5.11 after the ADP report on Thursday. Tom, we're back down to 4.84 this morning.
Let's pause and say why John Williams matters. First of all, he's a first-rate researcher. I put him in a class with Clarida for academic research. He's got the San Francisco tour of duty, and now he's at the New York Fed, which we all understand is a different Fed. But what's so important here is this odd phrase, R-starred, which is maybe a guesstimate of normal. And where will the new normal be? Will it be a normal, as Williams says, we are going to get back to pre-COVID normal? Or are we going to set with a higher inflation regime and a higher interest rate regime? That's why people care what John Williams says.
Just on the labor market, Tommy identifies some slowing in jobs, overall growth in the number of hours work being done in the U.S. economy, not growing that fast. A rise in unemployment and a further drop in labor demand is needed to help tame inflation. And Lisa, that is not something that we see currently in this labor market.
He talks about the likelihood of the unemployment rate going to 4% and then 4.5% by the end of next year. We're not seeing that, right? So if you don't get that, then what more do they have to do to really offset that? I will just give you a sense of what the counterpoint to that argument is from the Federal Reserve based on some individual companies. Zillow, the online home shopping company, where basically you're seeing shares up more than 4%. They're raised to overweight from neutral at Piper Sandler. The shares are already up almost 50% so far this year, at a time when the housing market is supposed to be falling out of bed because of mortgage rates being at 7%. This is the conundrum for the Federal Reserve that's looking at a market that has looked beyond some of those rate hikes. I keep watching the home builders, now online home transactors. Really interesting.
Terrible website. Terrible website.
You've tried it?
Oh, Zillow, awful.
It's
awful
hard
website.
to use, but I'm addicted to it. It's like voyeurism. Like you can look in on a city or a town.
Meet Yang.
Go on Rightmove in the UK. Superior website. Great website. If you can work it out. I spend a lot of time on these.
Yeah, obviously.
Probably search websites.
You're looking for a pile of bricks out in the middle of nowhere, the Cotswolds or whatever.
Would love that.
Do you find Savills? Is that like a good one?
Well, that's it. You're thinking sort of high-end property.
You told me,
so
you're looking.
Rightmove puts all the properties in the same place, your kind of properties, and then properties people can actually afford some.
Okay.
Now, a range
I was
of
looking at the Cotswolds. It's really lovely. Like
it's beautiful.
The sheep in the road and the whole thing. You know?
Yeah.
I could see you taking care of sheep.
Did you see Christian Horner's barbecue, his grill?
Yeah, I did.
Yeah.
It's a power grill.
Nice.
It was extraordinary.
Someone
It's like
designed
this
that for
round
him.
thing, like this dome that we've got
Yeah.
in the studio.
Well, he's like a stud. He's like,
We could stick a couple of stakes on that thing on the
Jerry
dome.
Horner was there too.
All right.
Very cool.
JP Morgan Chase, I'm also watching. Those shares up about 1.3% as they're raised to a buy from a hold at Jefferies. The reason this is interesting is because they report earnings on Friday and everyone's expecting Armageddon for the banks, or not Armageddon, but they're expecting some negative earnings results just simply because of the inverted yield curve. And what you're seeing is the biggest are the take-alls. In other words, JP Morgan is the take-all, and that seems to be what people are saying. NIO, and this I'm doing just for you, John. This is the Chinese-based electric vehicle maker. Those shares up 2.4% as Morgan Stanley says that their sales momentum shows big improvement last month. And this builds on what we've seen from Rivian. It's building on what we've seen from Tesla, even at a time when we already are seeing some signs of a buildup of electric vehicles on lots. We're seeing a lack of demand for some of the production. So this sort of bifurcation in news is kind of interesting.
Love reading. Is that Jonas over at Morgan Stanley? I
believe so, yes.
Love reading his work. Phenomenal analyst.
Oh, no, it's Tim Xiao.
It's someone else.
Over from China.
Oh, it's from China. Yeah. Okay, interesting. Well, the whole team over there on the auto industry is just fantastic. I will say this, though. My question really just centers around how green are these vehicles? Just when you go through the whole supply chain, start to finish, just how green are they? And when do you start to break even, if I can use that phrase?
And how much is it predicated on the idea that all of the parts will be recycled into future iterations at a time when the technology is quickly shifting? A lot of questions behind this, which is really awkward at a time when a lot of governments are trying to push these vehicles at the detriment of some other potential measures.
I'd lease them, TK. Personally, that would be my personal decision. I wouldn't purchase one of these outright.
Really?
I just don't. Can you imagine how much they're going to cost to fix? And when does that start to bite? 5 years, 10 years? I've got no idea how reliable some of these autos are, how long they're going to last, what the warranties are actually like. How good are the warranties?
Yeah, I wonder if it's like railroads in America where 1880, 1890 was ugly, and it took 50 years before the railroads figured out.
And then who knows, Tom? They're going to shove all this money into this effort. Who knows? Look what Formula One are doing with really, really sustainable fuels. Who knows what that's going to look like in
Mr. Magnuson this
5, 10 years.
Fire in
I know, it was rough, wasn't it?
Laura Ram was just shaking.
They didn't have a good weekend. Let's get to the researcher, Laura Ram, of FS Investments, maintaining her year-end forecast for core CPI at 4%, saying this: I'm still in the camp that inflation will be persistently higher than pre-COVID and that the genie won't fit neatly back into, Tom, the 2% bottle.
Really important statement and a brilliant note. The charm of Laura Ram is she comes from a foreign exchange background. She's chief U.S. economist at FS Investments and follows the data like an animal. I love, Laura, how you're looking at real yields. I just went in and looked not at the 10-year, the vanilla real yield, but the inflation-adjusted 5-year yield. It is, I'm thunderstruck. We're at 3 standard deviations. We're back to 2009. Are real yields now where they have a real effect on the American economy?
I think we've seen that. We were just talking about autos. These are the interest rate sensitive sectors that, have been impacted by Fed hikes, the nominal part of the cycle. I think as the Fed sort of transitions to the end of that, the decline, the edging down of inflation has this insidious effect via the real rates channel. And I think that's what we're going to continue to feel in the housing market, in the auto market. It's going to be a weight on consumers. You look at the interest rate burden that households are facing. It's not catastrophic, but it is a lot higher, and hundreds of billions of dollars matter.
What do you think this will do to commercial real estate? I mean, I get it. It's not a big part of the GDP pie, but it's emotional. And your charm is you're down in Philadelphia, rooting for Bryce and the rest of them. You're in Philadelphia, and the answer is you don't have that Manhattan stars in your eyes. What's commercial real estate going to do in Philadelphia or in Phoenix?
Well, and those are two very different questions, because I think we've seen geographically, regionally, a huge dispersion amongst performance. We're still very focused on finding the opportunity within a sector that's going to have some clear problems, like the center business district, where we are also experiencing a lower vacancy rate that seems to be settling in well lower than pre-COVID. But it doesn't mean there is an opportunity. That's what you've got to love about commercial real estate. There's so many sectors: multifamily, industrial. You're even seeing hospitality still doing pretty well, again, selectively. So it's an area where you can really dig in and find a lot of opportunity. It's going to find a new equilibrium. We're seeing that in housing. We're seeing it in commercial real estate. But right now, you really want to be the bank. You want to look towards income. There are ways to invest in commercial real estate because it's going to continue to be a really important sector for any portfolio to diversify into.
And Laura, this really speaks to your theme that you don't necessarily think that we're going back to the era of low rates and low inflation that we were pre-pandemic. How much is this the real issue, the threat that the disinflation that we're seeing in autos, in housing, in some other metrics is a head fake? And when that leads to comps year over year in 6 months that make it easier for inflation to go higher.
This is exactly the point that I try to draw out for people because housing has been a primary example. Yes, cyclical headwinds with interest rates, but structural tailwinds given the underbuilding and underinvestment that we've had in this sector for years. So as we look ahead, unfortunately, a forecast is in a recession is in my forecast, mild recession looking ahead into the beginning of next year. But it doesn't have to be severe. And the fact that interest rates are now going to offer investors two-way risk is an absolute game changer. We've had 40 years of, with exceptions, but a trend of falling interest rates. And it has caused investors, to change their behavior over generations. And looking ahead, if we get this bounce in our star, I think we're seeing it. Look at the Bloomberg Ag, right? It is flat on the year. Despite a lot of up and down, you cannot lock in a price gain and you're left relying on income that still is very low relative to where inflation is.
Laura, thank you for your input. Laura Rame there of FS Investments. Another person we need to catch up with soon is Carl Riccadonna over at BNP Paribas. Put out an interesting note yesterday, pretty punchy stuff. US consumers have spent an above trend pace over the last couple of years by leaning on excess savings built up over the course of the pandemic. This dynamic is fading. It looks set to end soon. Excess household savings likely to be depleted by year end. This is what the credit team over at BNP Paribas had to say. I don't know about you, Lisa, but in the last couple of days, hearing more and more people look for wider spreads based on where they are. They were south of 400 basis points for much of the last week. They say our study of bankruptcy filings for smaller, mostly private companies shows a default cycle is already underway. You put that together with projections on what people look for from earnings on Friday, I guess we'll see.
There's a lot to unpack there. The counterpoint to this is the NFIB survey that came out this morning that showed that small business optimism exceeded expectations. And that, yes, they're raising prices at the lowest level since 2021, but they expect to raise prices at the highest level since November, later on through the remainder of this year. To that point, though, other people are saying the same thing. Consumer spending has to fall off, if nothing else, because of the student loan repayments and because some of the extra cash has been running out.
That's later this year, right?
Later this year.
In the fall, Tom. One to watch.
It's evident in the travel plans of America right now. Is there anybody not on airplanes today? I would suggest the real yield here from Laura Rame. The real yield is a tangible issue. I had no idea how the 5-year, I don't look at it, I look at the 10-year. The 5-year real yield is a moonshot. Absolute moonshot. It's unthinkable, the effect of that, if it breaks out to new highs.
Lisa's done with flying, Tom. Done. You done with flying?
For about a week.
For just a week?
Yes.
You're away again? Bramwell gone again? Are you away again?
Yeah,
good for you. No, I love that. Good for you. Great. You enjoy the summer.
I am.
TK doesn't know how to do that. From New York City this morning. Good morning. Welcome to the program. If you are just tuning in, the equity market a bit positive, slightly firmer. We're positive here by 0.14%. Coming up in about 45, 46, 47 minutes from now, we'll catch up with Claudia Sahm, former Fed economist, with lots to say, I'm sure, Tom, about this inflation backdrop, this labour market, how things are developing, and ultimately a suggestion, I hope, on what she thinks this Fed should do.
She's getting a lot of visibility with the recession call, and the answer is the data's looking pretty good. I mean, there's about 2 days ago, she came out with a real statement like we heard from J.P. Morgan here in the last hour. You know what? How soft landing are we? I don't know if it's a soft landing, this or that, but maybe the recession gloom is slipping away.
It's been pushed out.
Yeah.
Let's be clear about that. Lisa, that's the big change relative to 6 months ago. There's been many, but the doom crew, it's just this 3-month rolling 3-month forecast for a recession, right? Just sort of like, every couple of months, you're like pushing it out again another 3 months, and then every 3 months, you're just pushing it out again another 3 months.
That's basically where we're at. And honestly, at what point do people just capitulate? And they're just saying, okay, maybe there won't be a recession, but we haven't really.
Well, I'm glad you bring this up, because of all the missed calls, right calls, wrong calls of the last 18 months, this recession call has been the silliest. And I give Matt Lazzetti of Deutsche Bank the greatest credit. I'm just saying, yeah, we're going to have a slowdown, but it's way out there. That's what he said a year and a half ago. And he absolutely nailed it.
You're calling those forecasts silly, TK?
I think the gloom forecast on recession, if you look at which
Win thin.
A lot of humility.
Of Brown Brothers Harriman on the FX market. And this dollar weakness recently. Up next.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Actual conversation. I'm happy for you.
We got to
TK.
do like sports.
I'm
We got to
not.
do Big Little. So
Come on. What sport do you want to do?
no, we should do sports like Big
Oh, right,
Little.
yeah,
so
yeah,
like
yeah,
in the
yeah.
break, they see us what we're talking
Sure.
about.
I think
here.
the sport is Gladiator that we're doing right now.
You know,
Absolutely.
I haven't seen the movie.
Are you still not watched Gladiator?
No,
I haven't either.
What?
Oh, good. Yeah, I feel
We should have a surveillance viewing.
What?
a surveillance view.
How have you avoided that?
I just don't have the time to watch. I really have to think
I'm sorry,
about,
what? You don't
Look,
have the time. I
have
know
the
some
time.
of the silly stuff you get
I've
up
got-
to on a weekend.
I've
You
got,
don't,
I've
you
got
don't
to
have the
decide,
time to watch a movie.
do I
With
watch
you.
Barbie or do I watch Gladiator?
And clearly the answer is Barbie.
Yeah, the answer is
Are
Barbie.
you actually going to watch Barbie?
No, I'm not
Okay.
going to watch Barbie.
Mission Impossible, I think, comes out
Yeah, I saw
tomorrow,
the
is it?
trailer.
Today?
I must admit.
Today? Comes out
it's-
today? I'm watching it Saturday.
Yeah, the trailer was actually, it had rhyme and reason to it. I was impressed.
Tom Cruise doing his own stunts.
Yeah.
You kind of come, Bramo? You can come with me?
Thank you.
Have a good time. It's going to be great. Futures right now on the S&P up by 0.1%.
Maybe we'll
I
update
think
it
Bramo just,
tomorrow.
that was a decline.
No,
That was
I
you
think
wanna
that it'd
come?
be super
Cool.
fun,
All
yes.
right, cool, great. Yields low by 3 won't. 3 basis points low on a 10-year. TK, 396.21. What's been interesting about the last few days is yields have come in on the front end for a third straight session now, third consecutive session. We're lower by a couple of basis points here on a 2-year, 484. Bit of dollar weakness started to come through. We've seen euro dollar reclaim 110. Sterling get close to 130, 129.35 at the highs, just above 129 this morning off the back of some pretty punchy wage growth data out of the UK, Tom.
Well, the 7% number, is that what you had? That's a big number.
Plus
That's like a
7% on some
ginormous
measures, yeah.
number. I don't really understand how that happens, but there it is. It's valid, and it really speaks to the optimist view. We've heard this from John Stolfus at Oppenheimer, reaffirming a constructive summer. Neil Dutta saying this is the heart of the matter: inflation ebbing, flat wage gains to actually positive real wage gains is the other side of the coin. John, I usually get hate mail. Thank you, Stephen, so much.
Oh, you got some love
for writing in. Yeah, he says, surveillance, it's timely. It's, timely
where's
and
this
balanced.
message coming from?
I don't know. It's Stephen emailed it in. He was very
Called
kind.
us timely and balanced.
We're timely and balanced versus others.
You? All of us?
Oh, no, all of us. It was a communal,
Oh, nice.
surveillance.
Okay.
Timely and balanced.
So balanced and timely.
One of the reasons we're timely and balanced is we talk to experts with their heritage. Win Thin is out of the Columbia Combine, and of course with his unique view of the South Pacific. He's global head of currency strategy at Brown Brothers Harriman. I need a renminbi update, Win. I mean, I was getting a rationalization the other day that the Chinese yuan really hasn't depreciated, really hasn't devalued. And I say baloney. I look on the Bloomberg screen and I see a real depreciation in China. How does that change the Pacific Rim?
Yeah, it's a big deal, Tom. I think some of those calls about the unchanged exchange are probably looking at trade-weighted, real, nominal, et cetera, et cetera. But obviously for the markets, it's that bilateral exchange rate, dollar yuan. Dollar yuan's going higher. To me, there's no doubt about it. And it goes really down to the monetary policy divergences. People's Bank of China is easing. The Fed is tightening. The U.S. economy remains strong. The Chinese economy is struggling. So to me, it's really a bit of a no-brainer.
Connection lost.
I think the Chinese outlook remains very, very concerning. Despite these announcements overnight that the policymakers are looking at some sort of further support measures for the property sector, it's really, I liken this to a Band-Aid on top of a gaping wound. And I just, there's no really easy way out of this. I think there's more and more talk about China going down the way of Japan's lost decade. That's something we have to keep an eye on. But really, short term, the outlook for China remains negative. And unfortunately, that's got implications for global markets, for emerging markets and commodities. And I think that's something we have to come to grips with.
Within your study of India, over to your Burma, and then around and up to Japan, do you buy the idea that the labor component of China will be moved to Vietnam, indeed moved to Burma?
Yeah, that's the interesting thing about China. There's actually an ongoing debate about whether it still qualifies as a developing country. That's one of the big debates that's going on in international organizations, because you get quite a few benefits from being classified as a developing economy. And China has moved up the development chain. There's no doubt about it. And the speed with which it's done so has been really amazing. I mean, we're talking about in a matter of 30 plus years, it's become on the cusp of being a fully developed country. Obviously, there's still issues with market manipulation, et cetera. But for the most part, China has been a big global driver of growth. And I think that's really fading. We're seeing more offshoring, as you pointed out, Vietnam, India, even Mexico, in our hemisphere. It stands to benefit from, I think, I wouldn't say it's deglobalization, but it's sort of re-globalization. As China pulls more inward, multinational corporations have to look for alternatives in terms of supply chains and production, et cetera, et cetera. So again, it's a lot of moving parts, but I think the bottom line is that really the global economy cannot count on China being the global driver of growth right now.
Right now, everyone's still looking to the U.S. as a global driver, as a global litmus paper for where we're heading with respect to rates and inflation, which is a reason why perhaps everyone's just tap dancing ahead of tomorrow's big number. The CPI report. There is a feeling right now that the dollar is headed weaker, even though we are getting hawkish rhetoric from Fed officials. Why do you disagree and see potential for a strengthening dollar at a time when people are seeing a divergence with the U.S. at least slowing the rate hikes and others continuing to do it more aggressively?
Yes, that's really a big question. That's the question I'm getting asked most by clients these days. Given how strong the U.S. is, the fundamentals are, why isn't the dollar doing better? Look, if you're negative on the dollar, I always bring this up as an FX guy. Where else are you going to look? If you don't like the dollar, what do you like? Well, look at the Eurozone. Germany is tipping into recession. If you look at the PMIs, I think France and Italy are already in recession. UK, Bank of England is tightening to 6.5%. That's going to go into a deep, deep recession. Japan is slowing. They had orders data out overnight. So it's we're the last man standing, and we should be drawing in capital. We should be drawing in much more interest in dollar and dollar assets. It's not being reflected. Again, and to your point, the Fed rhetoric is there. The market's starting to believe the Fed about a second hike. Maybe we start even talking about a third hike. So it's puzzling. I still look at this weakness as sort of a gift if you're a dollar bull. Obviously, I think we should be much higher. But at the same time, I can't make a case for going much lower. Rate cuts have been priced out till next June or July. So all the pieces are there for a stronger dollar, and yet we're not seeing it. I don't know what the trigger will be, whether it's some sort of bad news elsewhere or good news here. But I still remain confident that the underlying story for the dollar is strong, and that eventually the market pricing will reflect that.
Just quickly, Wayne, what cross are you looking at? Is it going to be the euro dollar, or is it going to be something else? We're going to see that dollar strength come to the fore a little bit more, in your view?
Well, to me, the biggest puzzle this week has been the dollar yen. I thought we were going to break up into the sort of 145, 150 range, and instead we tested 145, and now we're down at 140. Again, we go back to monetary policy divergences. The Bank of Japan is going nowhere. The Fed is hiking. That pair should be much higher, and that's to me the biggest puzzle. Dollar euro, yeah, it should be toppy around here, 110, 111. Again, I can't make a bullish case for anything going on in Europe in terms of the economies. So those are the two pair I would look at the most.
I've heard that so many times over the last decade or so. I can't make a bullish case on what's happening in Europe. Within there of Brown Brothers Harriman, it certainly turned out to be better than people expected 6 months ago. That's for sure. 9 months ago.
Yeah.
It was like the gas energy crisis that never happened, right?
Yeah, that's exactly where we're at. And we keep seeing that. I have to give a bit of a correction. I wasn't aware that Tom Cruise did his own stunts. And
oh, yeah. Have you seen that video?
61 years old. He drove a motorcycle off a ramp-like cliff in the Austrian Alps as part of it. He also parachuted onto a moving train. He's 61.
Yes.
He did this himself?
I know.
It's kind of a death wash,
What's
though.
he drinking? What's that diet?
Okay, but do you want to be doing that?
At 61?
Yeah.
I'd love to be able to do that at 61 years old.
Would you want to do that now?
No.
So there
I'd
you
like
go.
to be able to do that at 61 years old.
But not actually do it.
Can I clarify something Tom said earlier?
Yes.
I've made a career of this. Stephen, who you quoted earlier, I don't know who Stephen is. Stephen was telling Anne-Marie that he enjoys her timely and balanced reporting on the issues.
Oh, wasn't telling us?
Yeah, no, it wasn't for us.
Oh, okay.
It wasn't for us.
But we'll take it.
It was for AMH.
Well, yeah, she was.
Just to be very clear. AMH is coming up with Maria Tadeo very shortly. People watching the tennis, Tom. Alcaraz. That kid. Oh, he's special. So special. Gave Berrettini a bit of a kick in yesterday over at Wimbledon. Very cool. From New York, this is Bloomberg.
Welcome back to another special Wimbledon update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. Chris Eubank's dream run at the All England Club continued Monday as he took out 5th seed Stefanos Tsitsipas. The victory puts the American into his first quarterfinal at the majors on his debut in London. Up next for Chris, former U.S. Open champ Daniil Medvedev for a spot in the Final Four. And don't forget, you can watch all the action daily at 5 p.m. Eastern on Tennis Channel.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
The Fed, I think, is still in risk management mode.
I don't think the Fed's going to wait around, though.
This is not a credit crunch recession that we're anticipating.
What's going to break the equity markets?
I wouldn't be surprised to see more tremors in the months ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on television and radio. It's the slowest damn Tuesday since time began. Markets frozen, I say, waiting for CPI Wednesday tomorrow. John, I'm looking at the screen, and I'm just struggling to get to 8:30 tomorrow morning.
There's a feeling the week begins tomorrow for the economic data, onto CPI, onto PPI. For many people, the week might begin on Friday, where we get earnings season kicking off with the big banks, JP Morgan, Wells Fargo, Citi. A lot of talk in the last day or so about loan loss reserves, Tom. Loans going bad. Let's see if we get some insight into the U.S. economy in a few days' time.
It could be interesting to see, and what I would say all in all is it's this idea of, in the zeitgeist at least, recession analysis versus soft landing analysis. Not that I know what a soft landing is. I don't recall that in the textbooks, but that seems to be the partition right now.
Recession delayed, not avoided, seems to be the take of Thorsten Slok over at Apollo, who had this to say this morning. The lagged effects of Fed hikes will continue to drag the economy down over the coming 12 to 18 months, pushing back to some extent against what we heard from the likes of John Williams of the New York Fed. Speaking of Colby over the Financial Times, Tom, this morning, and he says recession is way more likely than a soft landing. And then you've got John Williams in the Financial Times essentially saying that in his base case is not a recession, in his base case is much slower growth.
Anybody know? I mean, can anybody predict this?
No, of course
Absolutely not. This is as silly as the dots.
But that guy's got to make a policy call at the end of this month.
No, Dr. Williams absolutely is qualified to talk about this, and it's somebody that we will listen to. But partitioning NBER recession or whatever recession is about as useless as the Fed parlor.
I couldn't agree. Who on earth in this market is waiting for a group of guys over at the NBER to turn around 6 months after the fact, Lisa, and say, that was it. That was it.
Okay. Just first of all, we start the program saying it's totally dead. Don't come to work. And then, maybe come to work tomorrow. Okay, maybe not. Maybe come to work on Wednesday.
Come on Friday.
Come on Friday, and then just go right on vacation for the rest of the summer, at least until July 26th when the FOMC delivers their rate hiking prognostications. I do think there's some interesting data coming out on the margins.
You tell them.
The consumer credit data that came out yesterday from the Federal Reserve. People don't want to lock in these high rates to buy cars, to buy homes, and you're seeing seeing that with loans coming down, but they're still using credit cards. Small businesses, they're raising prices at the slowest pace going back to the heat of the pandemic, and yet they're kind of thinking about raising them more later. All of these odd cross currents that suggest that we are going to get disinflation in the short term, but raise a real question mark, Tom, about the longer term.
Well, this is we talked about yesterday: short term, medium term, longer term, and all that. To me, I'm going to get it up here, John. I don't have it up right now. FOMC, go. Let's get out to the medium term of September 20. November 1, dare I say a December meeting where historically they do nothing. I think these are going to be absolutely critical meetings, given 4, 5, 6 inflation reports that we're going to get along the way.
I'm only showing up for Fed decision days for the rest of this year.
That's what you're doing.
That's all I'm doing. Sort of like sports commentators who only do, like game time. Yeah, I'm just doing Fed days.
Yeah, but I get the surveillance nap while Powell's talking.
Great. You fell asleep last time.
I fell asleep last time, and then we come back on and sound like we've hung on every word.
Elisa, you mentioned credit growth. Can we just sit on that just for a beat longer? So growth came in at the lowest in something like 2 years, right? Headline number. Can't that mean whatever you want it to mean?
Absolutely.
So how helpful is that information?
It's information that shows why perhaps you can see a decline in auto prices, because people aren't willing to borrow at these rates at a time when car prices aren't going up at the same kind of rate. So you have people who are underwater on auto loans. I mean, you're seeing that increasingly as a number of companies drop prices on cars where people borrowed to pay the higher price. It's raising this discomfort with these rates over the longer term. But it also, to your point, also means that people have cash and they can actually spend it. So,
if that number went the other way yesterday,
exactly.
You'd have people saying, oh, they've got to borrow. Things are tough out there.
Yeah, although do people really want to borrow at that rate?
Oh, no.
To buy luxury cars?
Not if you don't need to.
And that's, I think, the real theme. And we're going to be speaking with Jonathan
up
Miller.
to 7%. Yeah, the car loans, we talk about home mortgages, but car loans have ballooned.
Oh, it's more than 7%. You're looking at 12%. You're looking at the highest payments that people are ever making to own cars going back in the records.
John, data quickly here.
Sure.
I'm looking at Brent crude 78.16. It just creeps away from those low prices.
The future's slightly positive. I'm looking at equities, Tom, up 0.2%. Yields a little bit lower. We saw some dollar weakness kick in over the last few days. That's actually reversed in the last, I'd say, hour or so, actually. Breaking 110 again on the euro against the dollar. Euro a little weaker now. Tom, 109.90.
Joining us now, this is important for Global Wall Street. He writes a really intelligent note for Northwestern Mutual. Brent Schutte joins us, their CIO. And buried in the note is a really important observation that we've downplayed. I've been as guilty of this as anyone, Brent. And that is, you look abroad at the developed nation equities and you say that they are remarkable, that they are remarkably cheap. We're beginning to hear this in our analysis. What equities abroad are remarkably cheap?
Well, I think there's many parts of the market that are actually cheap. Consider that U.S. small and mid caps trade at 13 to 14 times earnings that are marked down 10 to 15%. And so I contrast and compare that to the large cap U.S. equities, which is where everybody has wanted to have been for the past few years, and they trade at 20 times earnings. And so I think you were mentioning short, mid, and long term. Unfortunately, I'm more of a pessimist. I do think there is a recession that is likely. I know that narrative has changed, and I think that puts more of a wet blanket on equities in the near term. But I do think in the middle, medium term, I do think the parts of the market that are cheap will do well coming out of what I believe will be a short and shallow recession. And that's where I encourage people to position their portfolios more towards those areas such as U.S. small, U.S. mid, and dare I even say international equities, which I know have underperformed for some time, but are remarkably cheap. And I expect better days on the opposite side of the recession.
Are there tech growth performers in the mid-cap area?
Yeah, but how much do you want to pay for those? I mean, I know that AI has been the craze. I know that earnings growth has slowed, and that's why people have gravitated back towards those. But it reminds me a lot of 1999, 2000, where that was the narrative. And then the next 7 years, those names did well from an earnings perspective, but not from a price perspective. And so I know not every time in history rhymes, but this time period feels a lot like 99 to 2000 in so many different ways, and that being one of the primary ones.
Tom earlier said that it's almost silly to discuss recession and all the gloom and doom. Earlier was perhaps not looking at the actual data, which showed a strong economy. How do you parlay that into a soft and shallow recession that could just ameliorate some of the inflationary pressures just enough to keep growth going on this kind of sphere? Do you think that that is the most likely outcome at a time when there is still this inflationary pressure that's rearing up on the back end of the year?
I mean, I think current inflationary pressures, as measured by CPI, are highly linked to COVID that is now in the rearview mirror and are going away. But that's not the big concern of the Fed. The big concern is wages. Every economic cycle ends when you run out of labor market slack, and that's where we're at unless people come back to the labor market. And so if you look historically, the Fed hikes rates aggressively as wages reach 4% on non-supervisory and production workers. That's where the last 3 economic cycles have ended, and we're at 4.7% year over year right now. I don't think the Fed stops until they see the labor market crack, which I think we call a recession. And so I think about this liquidity tourniquet that's on the U.S. economy, and I think that means a recession is likely in the coming quarters. The good news is that I do believe, unless you think the real neutral rate has changed from 2.5%, we're above 5. There is plenty of room, if inflation is gone, for the Fed to cut rates to kind of help cushion that blow. And when you contemplate the consumer still has ample savings and likely will after this recession, I think that's why it's short and shallow.
What keeps you up at night that could potentially challenge that assumption of a short and shallow to something that looks more traditional in terms of recession?
The Fed keeps hiking, and so I worry every single time the labor market comes out and shows supposed strength, and the Fed keeps hiking into that because they want to see it completely gone. I think they've probably already gone too far if they continue to go, based upon some belief that inflation is not completely back to 2%. I think every sign points in that direction. If they keep going and they go further and further until they get the labor market to crack, then I think you're going to see, or could see, something that's a bit deeper.
Brent, you said supposed strength. Is there more to this labor market that meets the eye from your perspective?
I mean, this is where I think people look at the data over the past year, and it's been very odd. You saw household employment last year for many months actually be flat. So from, I believe, February to November of last year, household employment rose a whopping 200,000 total, while non-farm payrolls rose 2.8 million. This recession commentary, does anybody realize that gross domestic income has actually been negative for 2 quarters? That's the opposite of gross domestic product. And so I think there's just so many conflicting data points. You have a post-COVID recovery that's quite odd. And I think the Fed is reacting to different data that is more strong. And they won't stop until they see it weakening. And hopefully they don't go too far and want it to weaken so substantially that it does cause that deeper recession.
How hard is it to be bullish with that kind of analysis on what the Fed is doing?
Well, I joined Team Abramowitz a few months ago and became much more bearish for the first time in many quarters. And you know, I think there's good news in it. It's more along the lines that you do see parts of the market that are cheap. And I think for people who invested in bonds for years, when rates were at 1 3/4 on the Barclays aggregate bond index, they're now at 5%. So you have the opportunity, I believe, to hedge your portfolio against downside by investing in bonds, which I think offer real value in a period of time where I think inflation is going back to 2%, and a hedge against equities once again, which I know they weren't last year, but I think they'll return to their historical kind of role of actually ballasting downside in equity markets.
Team Bramo, Brent, thank you. Brent Schutte there of Northwestern Mutual. Thank you, sir. Appreciate it. Bramo, you've recruited another one.
Let's be honest. I've actually become less bearish on the economy over the past year. When we were coming into the year, remember I was saying that there are some definite signs that we're not going to necessarily have some sort of downturn?
Of course, we
you
all
remember that, right?
No, not really.
But I think that there is this concern about inflation going back to that 2% level easily. That's the real distinction right now.
Who
that
says
really
2%
pulls
is a good thing?
Or 2.5%. Well, the Fed itself, they've come out and they said that they're committed to 2%. So to get there, do we have enough on that last mile? I've heard a lot of convincing arguments that we could potentially.
I love Brent Schutte. I think he's got a really interesting Midwest perspective. Guess what? The unemployment rate in Milwaukee, Wisconsin, 2.4%.
Yeah.
In the days of Pabst, Schlitz, and Miller, it used to be 4, 5, 6%. 2.4%.
Just got a message from a Bloomberg subscriber. Now she tells us. Now she tells us. If you're just tuning into the program, welcome to the show. The S&P 500 positive by 0.2%. Coming up very shortly, in about 18 minutes from now. Don't miss this. Claudia Sahm, former Fed economist. You might have heard about the Sahm rule, Tom. Everybody's heard about the Sahm rule.
State by state. It's a big deal. She's got a huge splash right now. You know, no question.
As well she should.
Yeah, she's really earned this. I mean, this is really core research from a PhD at the Fed who's gone on to other and bigger things. And she's getting some major love right now within the economics community about the granularity of a recession call instead of this aggregate foolishness we're doing.
Well, let's get to the aggregate foolishness just briefly. 3.5% unemployment, Tom. 3.5%. You heard Brent just moments ago. Supposed strength. He's not exactly on board with this idea that this labour market is doing really well.
Yeah, it's simple. If you don't have a job, it's doing terrible, and if you have a job, onward and forward. But the aggregate view away from the big cities, I'm sorry, sub 3% employment is extraordinary. I mean, we've never seen that.
Looking forward to the housing market conversation with you guys too. Jonathan Miller, the president and CEO of Miller Samuel, that conversation taking place in about 30 minutes' time. Don't miss that. Housing is so interesting in America right now. You've got mortgage rates surging through 7% over the last 18 months, and yet housing is recovering.
To your point, a lot of people, John, are buying with cash, a much greater proportion with cash. To your point, are they not taking out loans because they're concerned about the rate or because they don't have to?
It's uber rich. How many people do I know that are buying houses with cash?
Oh, you've got loads of friends doing that, TK. You've got they're all your mates, aren't they? Future's positive, 0.2%.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our 2 main threats: Russia's aggressive actions in our efforts to fight terrorism.
Continuing coverage today. Bloomberg, your global business authority.
The Biden administration has really been trying to ensure that this conflict does not become a World War III, does not escalate further. Where this ties in with the NATO membership, though, is NATO obviously has the clause that an attack against one is attack against all. So essentially, the idea is that if Ukraine was brought into NATO officially, while this conflict is still raging, would that then commit the U.S. and the rest of NATO to being directly involved in a way that most are not quite ready to be?
Very well summed up there. Controversial decisions being made at the NATO summit. Julie Norman there, the co-director of the UCL Center on US Politics. The UCL Center weighing in on the NATO summit, Tom, taking place in Lithuania. That one is ongoing.
Yeah, this is going to be an important conversation. We've got Anne-Marie Horton and Maria Tadeo coming up. John, You told me about this, and I'm looking at it now. The socialist Spanish minister uses a private jet to attend a climate
Can you verify
conference.
that? Have you verified that?
I don't know. I haven't verified
I've seen the
it, but
video too.
She's driving it with a bicycle.
So she gets the private jet, gets the car a little bit, and then gets on a bike to ride in, right?
Brilliant.
The virtue signaling of today's politicians.
It's just too
infuriating.
much. Maria Tadeo once did that, you know.
Maria wouldn't.
That's right.
Maria wouldn't.
Maria, she come in the private jet.
We think more of Maria than that.
We do. Right now, let's do this. The news flow out of Vilnius, Lithuania, this is one of the 3 Baltic states, I'm sorry, it's extraordinary. I didn't expect this. And Maria Tadeo was way out front in this with Anne-Marie Horton, with the President of the United States. Maria, let me go to you. Boy, St. Petersburg seems lonely. It's 240 miles from Helsinki by ferry to St. Petersburg. I've got Finland, NATO, Sweden, NATO. How alone is St. Petersburg at the very end of the Gulf of Finland?
And just to make it clear, I would not do that. I think if you're a politician, what you do is you fly Ryanair, you take a picture, then you put it on Twitter, and you say, here I am, I'm a man of the people, I'm a woman of the people. We want to play that PR card. But beyond the Spanish minister, who's already in trouble for that picture, by the way, I think today, really, that is a message that NATO wants to send, that this is an alliance that is stronger than it's ever been at this point. It has a new member now. Obviously, President Erdogan overnight dropped that veto. Sweden now expected to join the alliance, and this is growing, and they say we're as powerful as we've ever been.
Anne-Marie, I look at this and it just seems like a combustible moment. In your reporting from the team with the president, are they worried about a Putin response?
Well, I think they've always been worried about potentially wanting to escalate the war more, which is why many critics have said the Biden administration drags its feet when it comes to sending fresh weapons or the latest list that Zelensky is asking for to Ukraine. One issue, of course, many are talking about is potentially if Putin feels like he really has to double down, if this counteroffensive, which Greg Valliere writes about today, is really just picking up in the last few days, if this becomes to a point where we could see Putin maybe use a tactical nuclear weapon in Ukraine, this is something that is obvious a concern for not just the Biden administration, but NATO writ large. At the moment, though, no one has changed the nuclear posture. And really what the president wants to take away from this NATO meeting is that this is a win, not just for the alliance and the support they have for Ukraine, but his foreign policy win. He'll constantly say that what Putin wanted to do was divide NATO, and what he's done by his invasion of Ukraine was actually strengthen the alliance and also expand it, because now you have Finland and Sweden going to be 2 new members of this group.
And that's some of the known outcomes of this NATO meeting, the fact that Sweden will be incorporated into the Union and that Finland, of course, is a member. Also, the question around Turkey and its willingness to allow Sweden. What are some of the questions, Anne-Marie, that remain to be established through the remaining 24 hours of this meeting?
The real fight is going to come down regarding the language of Ukraine. I'm already seeing this play out. Biden spoke about this morning when he arrived at the summit, saying that he agreed with the language Jens Stoltenberg put forward for Ukraine regarding their invitation and ascension at some point into NATO. But there was a very strongly worded tweet coming from Zelensky saying that it is absurd what he is hearing about the NATO summit as he is en route to the summit. He's saying Ukraine is being discussed and the language is being discussed without Ukraine at the table. And he thinks it's just unprecedented and absurd that there is no specific timeline for Ukraine to join the alliance, or even for have that invitation to join the alliance. So how the world leaders talk about making sure they are 100% behind Ukraine, they want to strengthen alliance, but not have a specific time frame for Ukraine, that is going to be really one of the bigger, potentially testy moments we'll see here on the ground.
Maria, why is it that probably the most interesting person in this NATO meeting is Turkey's Erdogan and his role in allowing Sweden into the membership and his asks from the rest of the Union?
Well, because he's involved in all of the big talks. We know that, well, yesterday in Sweden, if Erdogan had he not sent that political signal, the Turkish parliament would not ratify this, and the Swedish would be out, essentially waiting in no man's land for potentially weeks, months, and obviously that is key. For Erdogan, it's almost a twofold decision. One we know is that he wants the fighter jets from the United States. He wants the F-16s, and he believed this as a goodwill gesture will also get the transfers of the planes. And then secondly is that we know this is an economy that needs international support, that needs obviously investment for international investors, and a lot of this has to do with presenting Erdogan now as not just a powerful leader in Turkey, but also willing to stay constructively on the international stage.
Is Turkey changing, Maria? Are you seeing a real change in leadership?
Look, I think it's very early to say. Obviously, again, it goes back to this question of, is this a fundamental political change, or is this about what do I get out of this? If I help the Swedish, what do I get in return? We won those planes. And then again, it's a question, obviously, of money. And we've seen that debate play out with the central bank, the economic measures that they may take. It is too early to say that. But the one thing that is clear, yesterday, President Erdogan was the star of the show. You should have seen him walk around the streets of Vilnius, selfies, pictures. He was the man of the hour. And obviously, that plays back home. He says, look, here I am. Not only I won the election, but I'm also extremely powerful.
Anne-Marie, AMH, good to catch up alongside Maria Tadeo on the ground in Lithuania as that NATO summit gets underway. We are starting to see some changes. I'm not sure if they are sustainable changes in Turkey, but Lisa, some changes on the monetary policy front as well.
It turns out that perhaps monetary policy that we understand is something that now Turkey understands as well, that if inflation is high, if you cut rates, that might not work. If you raise rates, maybe that will be a way to curtail inflation, and that's the new Turkish experiment, however, not as much as people previously
How's that going in the UK?
Yeah, exactly.
Bank of England still trying.
That's part of the problem, is it's a very difficult moment to be countering inflation. But to your point, at least that orthodoxy has shifted a little bit for the moment.
Yeah, it feels that way, Tom. Just a bit of a shift.
Right for the elections, flatlined at 26. It went out to 26 lira per dollar, and it's really flatlined there, where you say, maybe I'm doing it in my head real quickly here, we should be out to 27 or 28, but we're not. So they're holding their own right now to see if the finance minister, Mr. Semsek, who's hugely acclaimed by the West, will have Mr. Erdogan actually listen to him. That's, to me, the heart of the matter.
Next hour on Bloomberg TV, look out for this. Kathy Jones of Charles Schwab, Jos Concalves of MUFG, Jack Caffrey over at JP Morgan. Jack Caffrey's been great, you know, on housing, home improvement stocks. He's got a call to make on that, so looking forward to having that conversation about what he sees in the housing sector. Home builders on the S&P 500 doing tremendously well, why he thinks that fewer people may move and more people might be renovating their homes, Tom.
If we have Mary Daly's 2 rate increases, do we get an 8% 30-year mortgage or higher?
Potentially.
Have to.
Potentially.
Is the question then, will it matter? Will anyone actually be paying 8%
No, but
mortgage
it's like the dream goes away for millions and millions of people. Forget about the rich people buying all cash. I mean, the dream disappears.
Yeah.
That's all there is to it.
I agree with you. I agree with you. Futures right now, positive 0.2% on the S&P 500 from New York. Good morning.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg Surveillance. Good morning, everyone. On a vast economic day, Michael McKee, nowhere to be found in sight. I mean, he's just completely checked out. Bramo and I are going to go here to the economic data, if I can get it up on the terminal here. And
there is none.
There's a small business data. Small business data actually came in a little more constructive than what was expected.
It came out, at 6 a.m. I thought this was actually a really interesting report because it showed small businesses increasing prices at the slowest pace going back to 2021. It also showed, though, that they plan to increase the prices down the line at the highest pace going back to November. So this push-pull of the disinflation versus reinflating later on.
Let's review the inflation data because Claudia Sahm does not want to talk about it. CPI year over year, 3.1% in from 4%. To me, the operative University of Michigan phrase there, that's a ginormous move from previous month to the new survey month.
Significant disinflation, which is the reason why nobody seems bearish right now and everyone seems to be pushing off recession calls because we are getting the disinflation that the Fed wants, even if we're not incurring the pain that Jay Powell talked about last year at Jackson Hole. Again, the granularity of it. Can we get disinflation, true disinflation, without the job losses, without people taking smaller raises than people thought?
Claudia knows I like the Cleveland series on inflation. I think it's smarter than core, but there's core CPI. Year over year comes in 5.3. Into a survey tomorrow, 8:30, will be here 5%. I mean, 4.9% is a lot lower than 5%, but nevertheless, the trend's in the right direction.
Used car prices coming down, dropping the most since 2020. You could take a look at housing prices. At least they're plateauing. They're not necessarily rising at the same kind of level. You take a look at some other things as well. Even airline tickets supposedly are going down. I haven't noticed that, but...
Top of the Google search message right now is Shakira and Sir Lewis Hamilton. They're getting a lot of Google love coming off of the Formula One race. Right behind them in a Google search is Claudia Sahm. She is an economist, a former Fed economist and founder of Sahm Consulting, and she has been out there and visible over the measurement of recession. We're thrilled that Dr. Sahm could join us this morning. Claudia, you mentioned California. It's ginormous. It's as big as the German economy. And all of a sudden, California's unemployment rate goes from 3.8% up to 4.5%. Should we follow and be aware of California?
So we should be watching every state, every labor market that we can. Remember, the Fed's policy is set for the national economy, right? So we can't expect the Fed to get too excited about what's happening in California, because right now we have to. This could be there were a lot of tech layoffs. There were big disruptions in the Bay Area. So what we're seeing in California could be unique to California, or it could mean that we're headed to slowing overall.
What do you see in your data? I know mid-month you get a massive redo here. You'll have that out in 10 days, whatever. But what do you see right now? Let's get out in front. I need to make some news this morning, Claudia.
Yeah, well, the economy, the labor market is in a great place for people. So because the workers have had the upper hand. When I look at the wage data, which I think a lot of people were, wringing their hands over yesterday, it's like, how do you think you're going to get workers back into the labor market and deal with labor shortages if you don't pay them more? Like, this is Econ 101. So to me, seeing that we're still adding jobs, that's really good. So, but lots of people find a way to turn it into really bad, but I won't do that.
Claudia, I love your note where you said, it's not hard to find an angry macroeconomist. At this point, everyone's made mistakes and everyone's trying to figure out how to carve out a niche for themselves to explain what just happened. How do you understand the dissonance between everyone's expectations of where the economy was headed and what actually has happened?
Well, as I started there, every macroeconomist has missed something this time, right? And they're very different things that we've missed. So, and really, people get kind of not happy when they're making calls and they're not getting it. They sometimes get even less happy when they look around and see people who've made big mistakes all over the news. So I think that's where, I pointed out in this piece you're referencing on Bidenomics, is that, you got to take it with a grain of salt always, what your advisors come to you with. And I think right now, unless they're bringing a lot of nuance, it could do more damage than good.
But what are we misunderstanding, just to the point of the making mistakes? And we've all made plenty of them. But what are we misunderstanding about pandemic economics, as Tom would call it, or where we are in the recovery, or where we are in the distortions, whether it's California, people moving away from there, or the Northeast, or even people's propensity to switch jobs, shift locations, spend more than they otherwise would to capitalize on experience that they were denied during 2020?
Right, so I think it's all in there, right? The economy is upside down and backwards, and we need to be aware that every data release you get could be leading us astray because it's not clear yet. Are we doing the rebalancing or are we going down? And we'll know more about that in a few months. In terms of, what went wrong, I certainly was expected that the economy, the supply, would come back online more quickly than it did. And I think on the other side, we see this disinflation right now without unemployment rising, which is a huge puzzle to macroeconomists that would use models like the Phillips curve. So, we'll keep going at it. And that's where, as analysts, if we dig deep in the data, that's kind of where we should stay in terms of grounding our analysis.
Claudia, what I love about when you come on is my brain gets going and I'm doing research I usually have never done. Like, I've never done this, folks. Out of the percent of GDP of America, and there's like 23 states or so with under 1% of America's GDP. They're tiny, we know the names. Texas and California make up 23% of American GDP. Do people like you focus more on those big states, or do you aggregate everything together?
Frankly, there hasn't been a lot of work, say, at the Fed on regional effects. They have experts in the building who are not economists, and yet they don't play an integral role. I think, we need to pay attention to states because they could be the canary in the coal mine. Like, if we could get ahead of this even a little bit, if we get a recession, that's important. Now, I will say states like Texas and particularly Florida, like, they have more than recovered their losses in employment. So you want to look at the states, but that's not going to be the place you stop with the analysis.
Where do you look with the analysis? What do you look at with the analysis as you try to measure a SOM-like recession?
Yeah, I had no idea this was going to become such a thing because, I developed the SOM rule in order to start up fiscal policy, send out the checks. But, people want to use it as an indicator. That's fine. But the SOM rule is not a forecast tool. Right, it does not tell us about where we're going. It tells us about where we are. So, but knowing early in a recession that we're in one, that's helpful to know.
We're speaking with Claudia Sahm of Sahm Consulting, who is famed for her SOM rule with respect to employment. We're about 24 hours away from CPI in the United States. The headline is supposed to drop from 4% to 3.1% year over year. That is the headline figure, core less so, to 5% from 5.3%. Claudia, one of the big concerns that we've been hearing about from a lot of our guests this morning is a head fake when it comes to disinflation in the U.S. and the pace of it. We have seen used car prices come down. We have seen rents come down. We have seen some certain peripheral areas of the economy show signs of disinflating. Is it enough, and is it showing signs of consistency to bring us where we need the Fed, where the Fed would like us to go?
We're still in a place of a lot of uncertainty, and the Fed leans much more on the the using unemployment versus inflation. So that's more of like a rule of thumb, and we're so far off that, right? We're back to the days of before the recession when unemployment was so low, and yet inflation didn't pick up. And it's like, what is going on? So I think, we've carried that uncertainty about how those relationships work into the present. And that's partly why I think we come out of this with some rethink from the macro profession.
Right now, I'm also watching specific sectors, whether it's autos and the idea of prices going down for used cars. I'm looking at the housing market, the mystery of why housing prices haven't cracked at a time when mortgage rates are the highest going back since 2016, I believe, at the earliest, actually further than that. I think it was more than that, decades. Claudia, what sector are you looking at for a tea leaf in order to project where we are headed with inflation?
Well, I think you listen to the news cycle and you hear things like I had not planned on last week doing state-dependent SOM rules, right? But I did. So in terms of industry, it's like you go after where the story is. You look in the IT, the tech, and see it, like, what does that look like? And actually, some of it, there's some places where we had really a lot of trouble bringing workers in, like state and local government. They're like one of the big additions right now. So again, that looks like rebalancing to me. But like you said, you're going to pick up and follow any sector that is still higher inflation.
Claudia, I just had a nightmare. I was thinking about you as a Fed president or a Fed governor. Can you see Claudia at the Eccles building around the table?
Sure. I think she's
take
been
out pizza,
very close to that
Michelle
when she works
Smith,
at the Fed.
Michelle Smith will get her a Starbucks. Claudia, the character of the dissent right now at the Fed. I mean, we know that if you were there would be a visible SOM dissent. No question about it. What's the nature, the character of our non-dissent dissent at the Fed?
So I think it's really unfortunate that you have like straight line votes, and then you get to see a summary of economic projections that there's clearly disagreement, right? Like I don't know why they're shy about saying that, there's a lot of moving pieces here, and there ought to be somebody, and some of these people have been openly for a pause, right? And then there's been some Fed officials openly for going forward. How do you get a pause out of that? You think you're going to do 25 basis points more twice? Why aren't you doing it now? Right? Like that, everything was very puzzling with the Fed.
Claudia Sahm, thank you so much. Greatly appreciate it. Congratulations on the impact Dr. Sahm is having on our slowdown, stagnation, recession debate. I mean, it's amazing.
We don't even know where we are. And I think that is really the takeaway that we keep getting from pushing out the recession call. It's hard to figure out what kind of economic cycle this looks like.
Early in that conversation, she said the heart of the matter. She's not using the SOM rule as a forecasting tool. It's a statement of where we are right now. And I think half the battle is nobody really knows where we are right now when you've got travel as insane as it is, or we're talking about housing coming up here, and then you got other people flat on their back. I'm getting a lot of heat today from people that it's a struggle out there.
What kind of heat?
They're struggling. There's a lot of people out there struggling right now. The VIX under 15, 14.87, SPX up 0.2%.
One thing we haven't talked about at all today, Tom, is the two top PGA Tour officials who are heading to Washington, D.C. Did you see that? To talk about their merger with LIV, with LIV, with the Saudi-backed group. And they plan to say that there will be no influence whatsoever with the Saudis in the U.S. Golf Tour. And it's going to be interesting because it's going to be from in front of the Senate Permanent Subcommittee on Investigations at a time when there's real concern about how this is going to play out.
To me, the heart of the matter is the sport itself. I looked at the ratings of Formula One versus NASCAR, and NASCAR still has a very much larger United States TV ratings than Formula One, but the international ratings of Formula One are like Super Bowl ratings. They're like huge. And I look at golf and I go, okay, other than the Masters, Pharaoh's tuned into every hole. I'm not. The PGA, etc. Is anybody watching this stuff on the weekend? And I think the answer is no.
Full disclosure, I am not. My grandparents did, though. And I will say, there is this question. There is a question about how this transpires in general with Saudi Arabia's interest in sports more generally, right? And whether it's golf or whether it's soccer or football, whatever you want to call it.
U.S. Women's Open up 12% from last year. Thank you, Sports Media Watch, for this. But down 16% from 2016. That's the heart of this matter, is these people are all struggling about how to make this a sport after Tiger Woods.
And are they going to get a bailout, essentially, from the Saudis to keep it going? Coming up, we're shifting gears a little bit to the housing market. I'm really looking forward to this conversation. Jonathan Miller, President and CEO of Miller Samuel, curious to see how he perceives this strength percolating out as interest rates continue to rise. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
We're likely to need a couple more rate hikes over the course of this year.
My view is that the funds rate will need to move up somewhat further from its current level.
I would say we're close, but we still have a bit of work to do.
It will be interesting to see Mary Daly, Loretta Mester, Michael Barr talking yesterday on the various policies that are out there on the Fed. All of them, when they're not on the camera, Lisa Abramowitz, are trying to figure out where their kids can rent an apartment, wherever they are. I mean, that's the reality right now.
Or maybe who's going to pay for said apartment if their kids can rent an apartment. And certainly none of them are buying. Key question around where that component of the CPI, which is a major one, falls into play at a time when you've got interest rates the highest going back decades.
We're going to get right to it here because it's so important for our audience. We welcome all of you across this nation to a conversation with Jonathan Miller. He's president and CEO of Miller Samuel. All I can say, folks, is go to the Miller Samuel website and look at what he has wrought. He owns the high ground on owning and renting dynamics in major cities and indeed the nation. Jonathan Miller, what is the trend right now that's not in the zeitgeist? In all that Miller Samuel data, what's the number one thing that people aren't talking about?
Well, I think that housing prices are going to rise more than we think they are. Just in the last few months, things have really rebounded price-wise. And it's because I don't think there's enough of sort of consideration given to how much listing inventory is falling off trend, meaning that new listings entering the market are declining because people are heavily wedded to their 3% 30-year fixed. And it's going to take a while for that connection to wear
Well, that's a
thin.
key point, John. On the x-axis, how long is a while? Is this a 2-year, 3-year workout, or is this an 8 or 10-year workout?
No, I think it's probably 1 to 2 year, maybe more towards 2 than 1, but I think it's a while. I mean, one of the things that we learn is that homeowners take 1 to 2 years to capitulate to market conditions. And also too, that people, they have, it's shelter. They have personal needs. And at some point we see more people having to move into the market. The problem is that mortgage rates for those people are more than double what they were. But we're also seeing bidding wars expand because of the shortage, the chronic shortage of supply. So I think this is a couple of years out.
Jonathan, just to sort of give a sense of what we're talking about, is this on average in the U.S. or is this in select markets that are hot or hotter, like New York right now, at least, in other areas?
I see it as a U.S. I cover about 50 different housing markets for real estate brokerage, Douglas Elliman, and we're seeing the same pattern everywhere, whether it's Southern California, Texas, Florida, DC, Boston, New York City. New York City is probably one of the more robust in terms of activity, just because their sort of housing boom, if you call it, was interrupted a little bit early by change in Fed policy because they were late to the party.
If we push
this is a national condition.
If we push this forward, Jonathan, tomorrow we get CPI, the headline inflation rate in the U.S., and a lot of people are expecting some of the year-over-year comps with respect to rent coming in quite significantly because of the fact that we did see a slowdown, at least in the appreciation of home prices. Do you think people are overstating how much rents can either plateau or even decline, given the trends that you're seeing with pricing probably increasing more than people expect in the housing sphere?
I think it's an overstatement, and also too, I don't see the two markets as sort of a knee-jerk reaction where one instantly changes over the other. I think the rental market is mixed, where we're seeing certainly areas where rents are going down. New York Metro, that's not happening. It's very vibrant, so it's hard to imagine any kind of sudden move. I think we're going to be sort of stuck in this position for a while, unless there's a meaningful economic event like a recession, which has been forecast in 6 months from now for the last 2 years. We're sort of stuck at the moment, and I think time is what changes homeowners' positions in terms of bringing property onto the market.
How has the tenor of the purchases of homes changed? If people aren't necessarily taking out a 30-year mortgage in the same way, but maybe they're getting a loan from the actual home builder to buy a home, or maybe they're refinancing someone else's loan and putting their name on it to get the lower rate. I mean, how is the nature of the financing just shifted completely to avoid paying the punitive rates that are currently instated at the headline level?
Well, I always marvel at, the discussion about affordability is centered on the 30-year fixed, and that's sort of the benchmark. But I've been through many cycles, and you see people work through that, work around that, just with the examples that you gave. Home builders are doing a lot of offerings on financing, buying down rates. People are getting 5-1s, 7-1s, 10-1s as a way to reduce the payment. I mean, there's a lot of things that we didn't have to do 2 years ago because the rate was on the floor. That no longer exists.
John Miller, I'm fascinated what you would say in the case of New York to Governor Hochul of Buffalo and New York City in the state, or to Mayor Adams, or frankly the governors of Florida, or even the way you cover the fancy people out in Colorado with 8,000 square feet in Aspen. What would you say to public officials about the national outrage that to be selfish, our kids can't afford to live.
Right. So we go through this. It seems like we've had this conversation a decade ago and more than that. There's too much volatility in housing. One of the biggest problems is we just need to build more. The challenge is to make it middle class affordability. 40% of the middle class were sort of wiped out of the ability to buy a house in this last year.
I mean, John, we're going to run out of time.
Rethinking affordability, what affordability means.
John, we're going to run out of time here, but I want to get this in. I think it's too important. All the media, I'm as guilty of this as anyone. All the media wants to.
Year.
I mean, John, we're going to run out of time.
Rethinking affordability, what affordability means.
John, we're going to run out of time here, but I want to get this in. I think it's too important. All the media, I'm as guilty of this as anyone. All the media wants to look, as Lisa mentioned, OMG, the luxury people are putting $6 million all cash into 4,000 square feet where they can see, Connecticut and, they can see Pennsylvania over to the west. Forget about that. On the Upper East Side, over past 3rd Avenue, where people are just trying to do rent on 2nd and 1st Avenue, what's your prediction for the next 12 months?
I think that rents are probably going to peak at by the end of the summer, maybe sooner. But I see them stuck at some sort of plateau, not seeing any meaningful decline. That's kind of where we're in the rental market. Maybe rents aren't going to be rising, but they're not going to be falling.
John Miller, thank you so much. Just hugely valuable with Miller Samuel and Douglas Elliman. I put out on Twitter, folks, one of his PDFs, hugely informative as well. I think there was a lot of gloom in that. I mean, like the rent is not, the rents just are. I look at these rents for like 1 bedroom studios, and if somebody's popping a certain amount of money, you just can't get it done.
In New York, it's a different story than other places around the country. And he was talking about this being a much more robust market in New York City in terms of also it rebounding more from the interruption of 2020. That said, the divergence between these two markets is interesting to me. He said housing prices are going to increase more than people think. Fascinating moment. And yet rent's another story. You are seeing them come down in certain areas. This is a key input, one of the main inputs into headline inflation. So to have this sort of conundrum around housing prices and what people are willing to pay at a time when people are also trying to game out a recession call just highlights the uncertainty and the lack of predictability and any consistency and disinflation that we may see.
What I learned today, and this is really important, folks, Claudia Sahm, of course, you always learn with her because she forces you to think. And the answer is I was stunned at the concentration of percent of GDP in 5, 6, 7 states. And we know that from electoral votes and, House of Representatives and all that. But it's just amazing to me where we'll go, well, rents are declining in wherever, and yet it's this tiny teensweeny part of the economy. The big economies matter, and they're like New York, they're crazy.
This has been a year of splintering regions, splintering sectors, and a splintering economic cycle with respect to industries in particular.
You gonna be able to sleep tonight waiting for CPI?
Absolutely.
I don't think I can sleep. It's like
tomorrow will be a lot of fun.
8:30 tomorrow, CPI Wednesday. This is Bloomberg. Good morning.
The top names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio. Your global business authority.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
A quiet summer morning for once. We like that. Live from New York City this morning. Good morning, good morning. Equities just a little bit positive for a second day, up by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up. Fed officials say higher rates are needed. China signals more economic support and an early breakthrough for NATO. We begin with the big issue, the big bond market debate.
There's a lot of investors who are, really looking at the bond market.
Yields. I don't really see that much more upside.
A 70-80% probability that yields have peaked in this cycle.
The market is expecting yields to fall dramatically lower.
The real action, as you said, is really in the 10-year.
The end game is likely lower, back down to where it was. Who knows what happens between now and then?
This is a buying opportunity in bonds.
You're not getting paid to take the risk there.
The pain trade really is in the bond market.
So you have credit spreads widening out.
It does warrant treading carefully.
Wouldn't surprise us if you're looking at 700 plus on spread.
Let's see what the data is telling us.
The stronger the data comes in,
the more the Fed hikes.
at some point, you will see something break here, and I think it's going to come from the credit markets.
Joining us now to discuss, George Goncalves of MUFG, Kathy Jones of Charles Schwab. To the two of you, thanks for being with us. Kathy, first to you. Have yields peaked for this cycle?
Yeah, we think there's a pretty strong likelihood that 4.25 to 4 1/3 that we got last October is the peak of the cycle, but really can't rule out on the 10s going back up and testing these higher levels because the Fed continues to hike. So you have to sort of guess how deeply inverted the yield curve will be. We don't think it gets a lot more deeply inverted than -100 or so. So that probably puts the downside at a higher level than we had previously anticipated. But I think the peak has probably been seen.
George, do you agree?
Look, even if it has been seen, we could probably still retest it. This has been a very unusual hiking cycle, super aggressive, very fast from a low level of rates. Meanwhile, the whole term structure pretty much traded under Fed funds starting in late Q4 of last year. So the bond market's been skeptical throughout this whole period. And what really gets you is that final kind of sell-off, and it could happen now.
Kathy, what's more important from your perspective, that rates are going higher at the Federal Reserve or this cycle is lasting longer?
I guess it's that the cycle has lasted longer. I mean, I think it's important that the Fed continues to signal that they're going higher, and that means, further and further weakness down the road. But the longer they hold, the more there, in my opinion, risk of some sort of market accident or some sort of, economic accident. So we already had the banking incident, as Paul called it, in March. And I think the longer the Fed stays on hold, the higher they go, the more risk there is that we see other market incidents that take place.
SocGen agrees is something they've said too. And Georgia raises a question. I know you've pushed out your rate cut call into next year. How do you look at short rates at the Federal Reserve and push it right the way through the curve?
Look, this is a Fed that wants to stay on hold. The question is, will they have the wherewithal to stay on hold? That's really the question that we're all trying to determine. They did an amazing job of taking out the cuts for 2023, but they can easily come back, as we're all kind of concerned about something breaking out there. So I think, at this point, the bond market in the short end is respecting the Fed, but out the curve, we're still skeptical.
Well, let's talk about the prospect of something breaking. Carl Riccadonna over at BNP Paribas. This is what he wrote in the last 24 hours. U.S. consumers have spent at an above-trend pace over the last couple of years by leaning on excess savings built up over the course of the pandemic. Him and the team went on to say this dynamic is fading. It looks set to end soon, with excess household savings likely to be depleted by year-end. I want to pair that with the view over at BNP on credit. Our study of bankruptcy filings for smaller, mostly private companies shows a default cycle is already underway. Now, Kathy, if I look at high-yield spreads, a very specific part of fixed income right now, high-yield spreads are something like 400 basis points. And for anyone not familiar with the credit market, that's really pretty tight. That's pretty tight, which means credit is pretty buoyant, and things at the surface, at least, look okay. Beneath the surface, Kathy, do you see something similar that I'm hearing from Megan Robertson over at BNP Paribas, that their study of bankruptcy filings for smaller, mostly private companies is showing a default cycle is underway?
Yeah, we are seeing the same thing. So those bankruptcy filings are up pretty sharply. And we've been concerned about the private credit markets for quite some time, simply because there hasn't been sort of a mark to market, right? A moment of reckoning where they've had to come in and say, okay, well, that's, we're going to write things down. They're starting to write things down, but we haven't seen it actually happen yet to the full degree or realized in the public markets. So we do think that as we get the student loan payments coming back online, you're seeing a lot of trouble with financing now in the auto sector. Credit card charge-offs are picking up. Bank lending standards are tightening. All the components you need for some sort of at least a mini credit crunch or deterioration in high yield are there. They just haven't panned out yet. Maybe because a lot of companies have termed out their duration for another year or two.
George, just how resilient is this economy? And if we get those payments resuming on student loans later this year, does that lead to a soft patch for economic growth, or is that something we can weather?
Look, I do think that that just compounds the issues on the consumer side for sure. And to go back to the SMEs, I mean, we are seeing a kind of bifurcated credit market. In many ways, the credit, public markets, are very tribal. As long as there's cash to put to work and asset allocations have not shifted away from high yield, money's going to keep going back into that market. But at some point, this SME kind of being cut off from credit, the credit crunch is starting from the banking side, it works its way into the capital markets. At that point is when we're going to see, actual losses pick up into the actual, high yield market as well. But that's down the road. And so until that happens, you can stay with a very tight spread. But nonetheless, I do think that a credit crunch is on its way.
George, are you of the opinion that a process started several months ago with the failure of a couple of those banks in the United States, so that starts to spread in the months to come? We get bank earnings on Friday. Are you expecting to identify any of those themes, some of those issues starting to come to the surface?
Yeah, I think we're going to identify the issues that banks are going to have to pay for deposits. We're going to see that more clearly in the actual numbers. We're going to see that the regional banks probably have to come to terms with loan loss reserves, especially around CRE. And we're going to see probably less credit origination in general. So I definitely think that this earnings season is going to be super critical.
Bank earnings on Friday, CPI tomorrow morning. Going into that CPI report, 3 separate Fed officials making the case for further rate hikes this year in order to bring inflation back down to 2%. Enda Curran joins us now for a little bit more on that. Morning, Enda. Your view on where this Fed is going?
seem to be cementing that July rate hike, John. As you mentioned, Michael Barr, Loretta Mester, Mary Daly, all coming out yesterday making the point that inflation remains the number one priority. It remains too high, and that they see at least another rate hike, if not a couple of more rate hikes, for the coming year. Now, there was one standout yesterday. That was Raphael Bostic, who made the point that he thinks interest rates are already in restrictive territory. So he sounds like someone who would probably prefer to hold policy on hold. We do, of course, have inflation tomorrow. All the focus will be on the core numbers. But judging by the commentary from those three Fed officials yesterday, you'd have to say the July rate hike looks like a done deal now at this stage.
And John Williams, the New York Fed president, speaking to Colby in the Financial Times, had this to say: I don't have a recession in my forecast. I have pretty slow growth. I've got a counterpoint to that from Torsten Slok over at Apollo this morning, a timely one. He said the lagged effects of Fed hikes will continue to drag this economy down over the coming 12 to 18 months. That is why a recession is more likely than a soft landing. Enda, can you frame that debate for me right now? Who's got the stronger argument on the FOMC?
Well, right now, I think the so-called softer landing crowd are winning. Clearly, the jobs market's holding up better than expected. John, other sectors of the economy also holding up. But to your point, though, there's still a big question mark about where will we be 3 to 6 months from now when those interest rate hikes over the past year or so start to bite. Some hints of consumer spending is slowing down. You see some hints of softening in the jobs market, for example. So I think the debate right here, right now, is being won by the soft landing crowd. But, 3 to 6 months from now, it could be a different picture.
And let's just wrap up by leaning on your experience over in Asia as well. I looked at our reporting from our colleagues overnight when I woke up this morning on the Bloomberg terminal. Just some more suspicion, some expectations, fueled actually by Chinese media overnight, that perhaps we get some stimulus out of China. And how targeted is that stimulus effort going to be?
Fairly targeted. The measures overnight via the state press is essentially making it easier to repay loans, or pushing back the deadline for property developers to repay loans until the end of 2024. But, John, that's not going to be a game changer for the overall property sector. There's no sign that the government is coming in to reflate that broad sector yet. And we know, of course, property is 25% of the economy. It's one of the biggest drags on China's recovery this year.
And thank you. Kathy, to you on that, out of China, is that a game changer for you, a push for stimulus, targeted or otherwise?
Yeah. What China's doing right now is aiming at more political stability and trying to get that economy off the ground. But it's more of a kick the can down the road on the debt area in terms of the property sector. So we don't see it providing a big stimulus to economic growth globally.
George, what's your take on that?
Look, everything so far has been incremental. There hasn't been that really big bazooka type event yet, and probably won't come down the road either. I think that China's being very targeted with their stimulus, largely because they're trying to make sure they address the issues locally. And if it benefits the rest of the world, great, but it probably won't. So I think that we shouldn't bank on China really lifting all boats.
Hey, George, stick with us alongside Kathy Jones, just on the latest on China, the United States. In just a moment, we'll talk about Europe as well. Let's get you some movies. We can do that with Abby this morning ahead of the opening bell. Hey, Abby.
Hey, John. Well, we do have a little bit of a reprieve here for the NASDAQ 100 and some of that tech selling that we saw yesterday. And in recent days, Amazon is popping higher, up more than 0.6%. And of course, the Prime Day sale started today. It goes through tomorrow, so that's another positive. In addition, Wells Fargo has named Amazon a signature pick based on faster growth. 3M up 2.2%. It's not often that you see a stock pop that much on an upgrade to a neutral, but that is exactly the case. We do have Bank of America upgrading the stock to a hold, and this is a positive because they've had so many lawsuit issues. They recently settled that $10 billion PFA case. They still have earplugs, but apparently the worst may be over. And then finally, you're talking about JP Morgan and the big banks starting to report this Friday. Well, into that, JP Morgan is up 1.4%, up for a third day in a row, heading to its longest winning streak since early June.
Abby, thank you. Shanali Basak, 9:30 Eastern Time, 20 minutes from now, on that story over at JP Morgan. Coming up next on this program, big breakthroughs at the NATO summit.
There are ongoing negotiations where we could find a compromise, a clear, united statement on Ukraine. We should give all the possible help for them to meet the conditions of NATO.
That conversation up next.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
We should give all the possible help for them to meet the conditions of NATO. Then the other issue is that they would like to have some kind of security assurances. We know that in G7 group, they are also discussing on that. We will get more information in a couple of days from G7 too. So let's see how it will be formulated.
Major breakthroughs coming at the NATO summit. Turkey agreeing to back Sweden's membership bid. Secretary General Jens Stoltenberg saying he will push a fast track for Ukraine, as G7 leaders on the sidelines are set to negotiate over further bilateral security agreements. Meanwhile, the President, Zelensky, slamming NATO for a lack of a clear timeline and forceful tone. Let's get to the team coverage. Bloomberg's Anne-Marie. Maria Tadeo join us now for more. Hey, mates, let's start with a big breakthrough for you. What's number one?
Well, number one, I think, is you have the ascension of Sweden. President Biden is going to be claiming victory about this at this summit. He was able to, within 24 hours of this meeting beginning, make sure that Sweden was given the green light by Turkey. Now, Jonathan, the real crux of the matter for Washington is whether or not they're going to have the votes to make sure those senators that could potentially hold up those F-16s to Turkey, that goes through. I just spoke to Senator Durbin on the phone. This is the Senate Majority Whip. He is here on the ground, and he said those discussions regarding the F-16s were part of the dialogue to make sure they can get Sweden over the finish line.
Maria, how much of a change are you seeing developing from the Turkish side in the last 24 hours?
He certainly is the man of the moment. And Jonathan, we should always stress, when it comes to President Erdogan, he plays and speaks to multiple audiences. Obviously, he keeps an eye back home. He always wants to project that he is strong. Yesterday, he was the man of the hour. Every camera, every reporter was on Erdogan. That is what the Turkish people see. This is a leader on the international stage that is cutting deals. Then obviously, we know there's a situation with the F-16s. Now, the Americans will say they're not connected, but in the eyes of the Turks, they are very much connected. And then, of course, you have the international community, potential investments. We know that Turkey wants to perhaps present itself as now a country that is willing to play more by the book. This shows that Erdogan is constructive. And also, in particular, when it comes to Sweden, you also have the religious aspect of this. We know that faith is a crucial point for President Erdogan. He also speaks to the Muslim world. And yesterday, again, he was clear that issues like burning the Quran, he does not approve of. And Turkey will have to keep an eye on Sweden as to whether or not incidents like that continue. So we are seeing a shift. To me, the real question is this just Erdogan being nice at NATO, or actually do we see a fundamental change from the country? And that has significant implications for the economy.
Breakthrough on Sweden, breakthrough with Turkey, no breakthrough with Ukraine. Let's just sit on Ukraine for a little bit more. Anne-Marie, cluster munitions, highly controversial. The president supports Ukraine having them. There's been some pushback from elsewhere. What's the discussion like now on the ground?
Well, pushback from countries that are here, part of the NATO alliance, like individuals that have signed, these countries that have signed up to a convention to make sure that cluster munitions are not used. Because, Jonathan, if they do not explode on use, they could potentially explode years later when a war or conflict has ended. And that is why a number of countries, you've heard from likes of Germany, Italy, France, these countries have signed up to that convention to not use them. They are part of the NATO alliance. Also back home, members of the president's own party are also concerned about sending cluster munitions to Ukraine. What we've heard from Jake Sullivan on the ground here is the president's national security advisor. He talked about the fact that, of course, they wouldn't want to use these, but they really have no choice. Given the fact that Russia is using these cluster munitions, when they talked about the dud rate, the fail rate of Russia's, they say it's about 40 to 60%, and they would not be sending anything like that to Ukraine, where they say the U.S. cluster munitions have a dud rate of less than 2.5%, Jonathan. So they think, given that this is a counteroffensive and given that they want to support Ukraine, that now is the time to do it.
Maria, just a final one. A final question on the prospect for peace. Absent from the conversation over the last few weeks, in fact, the last several months, have the nations involved in this summit today given up on the prospect for peace anytime soon?
Jonathan, the word peace, frankly, I've not heard this being mentioned in a context of let's sit down and have talks between Russia and Ukraine. The word here continues to be let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield. When you talk to the Ukrainians, they still say very much the counteroffensive continues, and that is the focus. So if you mean, do we sit down and talk now? I have not heard that in not just today and here, but in potentially, as you say, weeks.
Maria, thank you. Maria Tadao with the latest coverage alongside AMH on the ground in Lithuania. Look out for the two of those. The team coverage continues through today on Bloomberg TV and on Bloomberg Radio. With us now, George Goncalves, Kathy Jones for a final word. Kathy, I want to finish in Europe and go straight to the UK. The wage data this morning, a 7 handle on wage growth. The prospect the Bank of England doesn't go just 50 basis points once, more recently, but they have to go again and do the same thing. Kathy, is that a UK issue, or do we have a broader theme here in the West?
Oh, I think it's more of a UK issue than anything else. I think the UK has had very unique circumstances in this cycle and continues to deal with those circumstances. And I think that they're probably behind the curve relative to the rest of the G7 nations in terms of tightening. So we see the UK kind of as an outlier here. I do think that inflation will come down, but I think it's a much slower process in the UK than in Europe, where we're already seeing it slow down, and certainly in the US, where we're seeing it come down.
George, UK problem or broader issue?
So, look, I think it is definitely more specific to the UK. Each region and country has been going through these issues in lagged kind of format. In the past, even having said all that, bond markets do trade with some correlation, especially the major bond markets. And so if we were to see continued pressure in UK markets, it could spill into the US. But I'm still focused on Japan, and if they ever do change YCC, that's a bigger issue down the road, more so than if UK rates keep going higher.
George, for a long time, Japan has seen this as a once-in-a-generation opportunity to reset inflation expectations. They've been looking for this for decades. Why would they look to end it?
Look, at some point, you have to kind of think about just the overall the financial system and just that part as well. So I think that getting some normalization over the course of the coming year is probably something that we expect overall. The timing is going to be the big issue.
Kathy, if we had a change in Japan, have you done any work on what that would mean for Treasury yields? How much spillover would there be from JGBs elsewhere?
It would really depend on the pace and the format that they follow in terms of exiting YCC. But it is something we think about quite a bit and have done some work on. So it clearly, because Japan holds close to $1 trillion in U.S. treasuries, it would clearly have some impact. It'd probably have an impact on the currency too. So it's one of those things when people ask me, what do I worry about? I worry about waking up one day and finding that they've exited YCC overnight. But that being said, I don't think that's what's going to happen. I think as gradually as possible, Japan will try to ease their way out of yield curve control. I don't think that they're in the business of or have see any real benefit from exiting quickly.
If there's anyone left holding JGBs outside of the BOJ, they'd be worried too. Kathy, I'm sure. Kathy Jones, George Goncalves there on the latest in the global bond market. To two of you, Thank you. Yields just turning higher at the front end of the curve. Over the last couple of days, they were lower. They were lower again this morning. They now inflect just a little bit higher by 2 basis points. 488 on a 2-year. On a 10-year Treasury this morning, down a single basis point, just south of 4%. 398 going into inflation data tomorrow. PPI data on Thursday, then on to bank earnings this coming Friday. Up next, the morning calls, and later, JP Morgan's Jack Caffrey joins us around the opening bell to discuss recession odds for the second half, as seemingly the consensus seems to be you push out the prospect of recession and then just keep pushing out, apparently. That's been a story of the year so far. That's coming up shortly from New York. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Minutes away from the opening bell, equities turning just a little bit higher this morning for a second consecutive day, up by 0.2% on the S&P. On the Nasdaq 100, up by about 0.1%. That's the price action. Let's get you some morning calls. First up, Wolf Research downgrading Alcoa to underperform, expecting softer aluminum prices amid rising output and weakening demand. Next up, Jefferies upgrading JP Morgan to buy 165 price target, highlighting the investment bank's stable earnings outlook and diversified revenue profile. That stock is up by 1.2% ahead of earnings on Friday. And finally, Evercore downgrading JetBlue to underperform, pointing to weakening fundamentals and growing headwinds to its balance sheet. That airline in the pre-market, negative 1.5%. Coming up, JP Morgan's Jack Caffrey making the case for quality stocks ahead of a second half filled with question marks. That second half underway. Your opening bell is coming up shortly. Equity futures up by 0.2%. The opening bell 4 minutes away.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Seconds away from the opening bell this morning. Good morning. Equity futures positive by 0.2%. Positive yesterday to start the week. Let's see if we continue the streak. On the Nasdaq 100 up by 0.1% as well. Just a little bit firmer going into CPI tomorrow and earnings as they kick off on Friday. The opening bell in New York City rings. Switch up the board and get to the bond market. Yields look like this. Treasuries pretty stable, unchanged. 398.60 on a US 10-year. Yields coming in a single basis point. On a 10-year, on a 2-year, last couple of sessions, yields lower. Just think about the range on a 2-year. Intraday on Thursday, post-ADP blowout. We forgot about that quickly. That 2-year intraday, 511. This morning, dropped to as low as 482.20. With that, some dollar weakness over the last few sessions. This morning, some dollar strength. The euro, just a touch weaker. Euro-dollar, a break of 110 in one direction, a break of 110 in the other. 109.91 on the euro against the US dollar. Crude a little bit stronger, firmer, higher, positive by 1%. $73 and about 70 cents, just short of 74. 40 seconds into the session, equities up by 0.2% on the S&P 500. On the Nasdaq, up by 0.1. One sector to watch at the open is big tech. The Nasdaq 100 planning a special rebalancing to curb the dominance of its 7 largest companies. The index saying the adjustment will, quote, address over-concentration in the index by redistributing the weights. Abby has more. Hey, Abby.
Hey, John. And yesterday we had some of these big tech stocks, specifically what's being called the Magnificent Seven, Apple, Microsoft, NVIDIA, Amazon, Tesla, Meta, Alphabet, trading lower, with the exception of Meta. Yesterday, Meta did actually get a pop from its Threads popularity and that user surge. But for the most part, these stocks were down 1 to 2%. Today, we're seeing a little bit of mixed action at this point, actually. Microsoft now turning lower, Apple up just slightly, Amazon up slightly, but off of its pre-market lows. So investors are still worried about this rebalancing, and it's a special rebalancing because typically these are an annual or a quarterly event. But it seems that NASDAQ is noticing what investors are talking about, the dominance of these stocks. More than a 50% weighting to the NASDAQ 100. The reason stocks are lower because, of course, index managers, they will have to reduce their positions to the new weightings. We'll know those new weightings on Friday. The actual changes will happen on July 24th. And if that weren't enough, we also have valuation concerns. The Fed, if the Fed suggests in this meeting that they really could be hiking longer and further than expected, that will hit tech. And then, John, of course, earnings for these stocks, it's not until later this month, but lots of pressures here for big tech. And again, mixed action for many of these big tech names.
Abby, looking forward to that. Thank you. Just to stay on tech a little while longer, guess what Dan Ives is of Wedbush? Dan Ives is bullish. He expects a big tech rally to continue another 12 to 15% this year. We believe a new tech bull market has begun to take shape, being led by the AI revolution. We see better than expected 2Q earnings over the next few weeks. There will be winners, there will be losers, but ultimately we see a strong second half ahead for the tech sector after a pretty blowout first half for tech. particularly on the NASDAQ 100. That's tech later this month, as Abby pointed out. The financials, they begin this Friday. Jefferies upgrading JP Morgan ahead of earnings. The analyst writing, while JP Morgan has been a recent winner, we upgrade the stock to buy given a stable earnings outlook, best-in-class ROE profile, conservative reserving history, and better revenue diversity. Shonali has more. Hey, Shonali.
John, JP Morgan is against the pack. When you look at the expectations for earnings season, there's a lot of pressure on the banks, particularly the regional banks, but JP Morgan, already the most expensive of the biggest banks when it comes to a price-to-book ratio here, is getting an upgrade over here from Jefferies. Jefferies is looking to JP Morgan, Goldman Sachs, and Morgan Stanley to really weather the storm that you're going to see in net interest income, as well as any potential worsening credit standards. When you look at what Jefferies is saying about JP Morgan, as well as what Wolfe Research has said, they value JP Morgan for being conservative when it comes to reserving. Remember, there are only 4 banks right now in the KBW Bank Index that are up on the year, JP Morgan being one of them, Citigroup as well, Wells Fargo being another. All 3 report on Friday. Interesting note that Jefferies makes about Morgan Stanley and Goldman Sachs. While they prefer them, Daniel Fannon over at Jefferies is also looking at they call it a tough everything when it comes to sales and trading. They reduce their second quarter EPS estimates for those 2 banks, even while preferring them as a bank, because they are worried about what those numbers look like when it comes to investment banking sales and
Can
trading.
we just dig into loan loss reserves, Shonali? The FT wrote up a nice story yesterday, actually leaning on some of the data that we have from the analyst expectations around loan loss reserves and loan losses. How bad is this going to be on Friday?
I think you have to watch 2 things at the same time, don't you? You have to watch how much people are reserving for the next couple of quarters in the next year or so, but you also have to see how much those loan loss reserves are converting into credit losses. We are starting to watch some deteriorating conditions, and you're seeing aggregate data show you here that credit, auto, that you're very worried about credit cards and auto loans, and a lot of these banks have bulked up on credit card debt to their consumers to boost NII. If you look, when we were talking about that KBW Bank Index, actually the #1 performer is Capital One. They're up a whopping 17% on the year, and they report next week. And so I think you have to watch both the banks and the credit card companies at this time. There's a lot of worries, even when it comes to Goldman Sachs, about their commercial real estate book. So I think it's going to be a very messy quarter here when you look across all of the loan books across all the different banks.
Shonali, thank you. Kicking things off Friday, JP Morgan, Wells Fargo, Citi. I want to get to Uber. Some changes in the C-suite. Nelson Che, the CFO, planning to step down, marking the most significant executive departure since the company's IPO. The company saying this in a statement. Over the past 5 years, Nelson has been essential to putting Uber on secure financial footing and steering the company from billions of dollars in losses. Bloomberg's David Welsh joins us now for more. David, the stock's down by about 1%. How significant is this move?
I think Nelson Che brought a lot of stability to the company. He's very respected. Before Uber, he was at CIT, he was at Morgan Stanley. I think on Wall Street, very well liked. If you look at what's happened over the past few years with the company, they went from this huge, crazy push for growth that cost them a lot of money. He reined in costs, even while they were diversifying into freight and goods delivery, so they've got more diverse sources of revenue, pretty good growth still, but they've got positive EBITDA. What they don't have is net income. So I think there'll be some questions here from investors. Who's going to come in next, and what does this mean for the next phase of the company? Because Uber still has a lot of challenges ahead. Even though they still have growth and they've kind of reined in costs and they're closer to net income, they still have never posted actual net income. And they're under a lot of pressure. There are moves in New York City and other major markets to push up the pay for the drivers. There was a recent LRB ruling that says their drivers can unionize, which could raise their costs. And a lot of their positive EBITDAs come from raising their rates for Uber for their fares. How long can they continue to do that? So there's still a lot of challenges ahead for the company, and they're going to need a steady hand at the till to keep costs in check and help the company continue to find growth.
David, this comes in many cases without any real competition from Lyft, which has been struggling much more, relatively speaking, to Uber. Are you describing just a problem with the industry then? Is this just a difficult industry to make money in?
It is, and it has been for a while. And look, remember, years ago, everybody said you couldn't make money in ride-sharing, ride-hailing without autonomous vehicles. Now that autonomous vehicles are sort of a big question mark themselves as to how well they're going to work and when, people aren't really saying that, but That is kind of working on the distant horizon, isn't it? When you've got General Motors with Cruise and you've got Google's Waymo out there offering ride-hailing with self-driving vehicles in a few different cities right now, that could change the game and really make it tough on Uber and Lyft. In the meantime, it is a big question. How are they going to make money? And even if they get into the black, what kind of margins are we seeing from that business?
Stock down 1.5%. David, appreciate the update. David Welch there out of Detroit on the latest from Uber. I want to turn to some fresh M&A news. Berkshire Hathaway purchasing Dominion's 50% stake in an LNG facility for $3.3 billion. The company writing this: "We're proud of our operations at Cove Point, excited for the opportunity to increase our ownership in these world-class facilities." On a story, here's Katie. Hey, Katie.
Hey, John. Well, Warren Buffett's Berkshire Hathaway now owns 75% of Cove Point after agreeing to pay $3.3 billion to buy out that stake from Dominion. Now, for some context here, Cove Point is a Maryland LNG plant that Berkshire first took a stake in back in 2020. It's one of just 7 operational U.S. facilities that's able to export, LNG right now. And now Berkshire controls it. And for their part, Dominion said in a statement that they're going to use these proceeds to repay debt. And of course, this deal comes after natural gas prices surged in 2020 after, of course, Russia invaded Ukraine. But so far this year, prices have dropped more than 50%. If you look at the reaction in the share price, you can see that Dominion under pressure right now, Berkshire up a little bit. Usually it's the opposite dynamic, John.
Katie, thank you. So far, their stock is negative. Dominion, at least. The broader market so far up by 0.3% on the S&P 500, 9 minutes into the session. This follows the best first half on record, leaving strategists very divided over where stocks are heading next. RBC's Lori Cavacina weighing in.
I personally feel pretty neutral. I don't feel like the market's been crazy. I do see the potential for some upside, but this is a December 31st game.
JP Morgan's Jack Caffrey planning to navigate the uncertainty by staying up in quality, writing this: "One measure of quality we think is compelling is from growing dividends. They're a measure of earnings quality. Encourage management discipline and align the interests of management and shareholders." Jack Caffrey, I'm pleased to say, joins us right now. Jack, I actually wanted to start in the housing sector, where you've really helped lead us through some pretty good moments, actually, for housing. Home builders on the S&P 500 have been absolutely flying. Can we just start with the broader industry? Are we seeing housing trends improve, Jack? Are things actually getting better?
Well, I think when we look at housing, you really have 2 markets. You have the market for new construction, the home builders, which has been on fire because that's really the only supply. The market for housing turnover has remained really quite sluggish, when you look at mortgage rates that are 150, 200 basis points above what the average consumer is carrying. So you actually have seen the consumer forced to stay in their home. And so I do think we're going to continue a bit of a tale of 2 cities, with the best of times being the builders bringing supply, and the worst of times being still that housing turnover, especially if you were looking to move into something bigger. You just can't find anything, to say nothing about the cost of actually trying to make that move. That makes me think that actually renovation might be the way forward in the existing home stock.
Jack, how much is renovation, the likes of, say, a Home Depot, lagged what's happened with the home builders so far this year?
Well, sure. Looking at the home improvement chains, that they have actually been spending very aggressively, Home Depot and Lowe's, and trying to become more pro/contractor friendly. But that winds up being 30, 40% of sales. That leaves 60% coming from you or I having, well, actually, my friend or my son going into Home Depot in order to actually get the wet vac to clean up after the flooded basement. That actually is a nice little pit, nice little driver. I do think that you have seen some of those costs coming down as you've seen lumber prices falling, bringing in some deflation into the top line, but improving some of the margin story going forward. You are also seeing some pressure on labor. And that's not just a Home Depot home improvement channel. That's a broader retail channel. And that actually, I think, supports the idea that the consumer remains engaged overall. People are working, unemployment's low.
What they're not doing, though, Jack, is taking credit. We saw some of the credit growth numbers yesterday, actually pretty low. As you've pointed out, people aren't moving. They don't want to give up 3% mortgages. I don't know many people who want to take on a 7% mortgage. Jack, is that a reason to avoid some of the banks?
Well, I think there are 2 parts to the bank story. Right now, certainly the mortgage market is not going to be helpful. I do think we're going to be watching credit trends very carefully on Friday. And I think even before we start talking about losses, what are we going to see with delinquencies? You are, I think, especially when you start thinking about credit cards, you're starting to talk about those are loans that are pricing and costing the consumer, for a consumer who's stretching, 20+% on their credit cards to low mid-20s, for a consumer not actually paying down balances. But if the consumer works, generally that's still a constructive backdrop. We've also heard lots of noise about how weak the capital markets are. And so you've seen a lot of fee pressure on the banks, and the more diversified the bank, to some extent, the more pressure they've been under, whether it's lack of M&A, lack of capital markets activity, lack of trading activity. So it does mean, I think, focusing on what's the pressure to raise focus and pressure on net interest margins, as well as what the credit experience looks like. Right now, the credit still looks fairly robust. I think that's reflected in other market measures. Credit spreads remain relatively tight.
Jack, the word defense means different things to different people. What does it mean to you?
Well, I think defense historically would have been looking to places like utilities and consumer staples. And those groups have traded very much like bond proxies this year, with, as we pointed out just moments ago, when Dominion was selling assets to Berkshire Hathaway, stock has actually been fairly weak, and they're using that to repay debt. Consumer staples, you wind up looking at stocks that are trading like that they are almost secular growth stocks, and yet their customer base is not actually expanding all that dramatically. They've been leaning very heavily on price, and retailers are now starting to push back on that price. I think that makes the less traditional sector that becomes more high quality and more defensive healthcare. You're starting to see better utilization. That has pushed and put some pressure on some of the health insurance companies, but points to better volumes, better trends in some of the medical device companies, some of the healthcare facilities companies, which benefit from control pricing, better labor, which actually gets you better utilization, and offers you actually some dividend growth as well. So you can come back to healthcare broadly, a sector that's cheaper than market, has better growth than market, has better income than market, albeit it's hard to find one or two stocks that actually offer you all three of those things in one basket. And I think it comes back to why you can't just buy a single stock and say, that's my view. It comes back to a bit of a diversified portfolio context.
True. Jack, appreciate the input, the insight. Jack Caffrey there of JP Morgan. 14, let's call it 15 minutes into the session. Equities up by 0.1%. Coming up, media and tech moguls gathering in Sun Valley.
I would not put high odds on a transformative deal coming out of Sun Valley. We're in a moment of sort of reassessing and rationalizing.
The summit in Idaho getting underway. That conversation coming up shortly.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I would not put high odds on a transformative deal coming out of Sun Valley. I think we're at a part in the narrative where we went through a flurry of transactions as everyone tried to scale up to lean into streaming. And I think for the most part, the losses have been larger than most people expected. And now we're in a moment of sort of reassessing and rationalizing. It doesn't strike me as a period for transformative M&A.
Tech and media giants gathering in Sun Valley, Idaho, with AI, streaming, potential mergers all in focus. This as Microsoft cuts hundreds of jobs in a new round of layoffs, and Amazon's Prime Day kicks off. Let's get to the coverage. Bloomberg's Ed Ludlow, Pudam Gore, joining us now for more. Ed, describe Sun Valley for me. Isn't that the episode in Succession where they go around in those vests and walk around in the valley? Isn't that it?
Exactly so. Summer camp for billionaires. It's interesting what that last guest said, though, because the focus this year is back on TMT. A year ago when I was here, it was only one story, Elon Musk's purchase of Twitter, and he was the surprise guest. But there are two deals we're focusing on. One is the future of Hulu. Comcast owns 1/3 of Hulu, but they have an agreement in place that they can require Disney to buy out that stake. My understanding